was like Hello, good evening, everyone. My host, kindly confirm you can hear me, sir.
Yes, go ahead, ma'am.
Okay, thank you very much, sir. I welcome each and every participant here today. Thank you for joining us in on day two. You're welcome to August 2020 FCA Webinar Forum, and we appreciate your patience so far. Yesterday was day one, and I guess it was a very interesting session we had yesterday. Today is the day two, and our facilitator who started yesterday in person of Mr. Ayomi Ladoku will continue with today's section. So this is FCA, First Choice Accurate Sources Link. We are an accounting and finance resource center, and our focus for today is on COVID-19 spotlighting key accounting standards for financial reporting. So I'll hand over to our facilitator who will continue from yesterday's class. Mr. Ayomi Ladokun, sir, kindly continue with today's session. Thank you.
Okay, you're welcome. Thank you. My host, please confirm you can hear me before we continue.
I can hear you.
All right. Thank you very much. I want to welcome everybody once again. We're going to continue straight away from where we stopped. Thank you so much for coming on board, and hopefully we are going to have a very nice time together. And I think I'm having a new person in our midst, Mr. Emmanuel. If I'm correct, Adeoye, you're welcome. Um, Thank you for joining us today as well. We won't be able to wait for some of our other colleagues that might also be trying to join the webinar. So we need to start straight away because we have a lot to really look into this evening. Okay, so I will beg your indulgence earlier on that we might, you know, extend beyond 10 p.m., maybe around 10:30 to 11. Okay, so I want to crave your indulgence. Okay, uh, so thank you once again. Thank you, Mr. Emmanuel. You're most welcome. Okay, so yesterday we checked IS 36 and IFRS 5. I want to believe you have a very uh, great idea, understanding about those two standards. Okay, but for the purpose of or the benefit of people that are probably just joining us today, you're going to have access to the video. Okay, and even for today as well. So from tomorrow, be Monday or Tuesday latest, you have the links to download the videos in your email. But in the meantime, let's have a look as IS 10. Yeah, within the next 20 to 10 minutes, we should be able to, deal with this issue. Okay, this IS 10 event after the reporting period. So if you noticed yesterday, we were trying to spotlight some key accounting standards, that came to the limelight or to the spotlight because of COVID-19 pandemic. Okay, and IS10 is one of them because it deals with events after the reporting period. As I was saying in the last section that there were convergence, around the world, especially from the ISB, to see whether COVID-19 should be treated as an adjusting event or as a non-adjusting event. So I'm going to be telling you, even by the time I explain the whole concept of the standard, you should be able to determine yourself whether COVID-19 should be taken as adjusting event or non-adjusting event. So let's look at event after the reporting period. Okay. Now, like usually, like I will always handle any standard. I don't want to assume you are familiar with this standard, so I'll just assume zero knowledge, but at the same time, I still have to, be a little bit faster than yesterday. But notwithstanding, I promise that you're going to get the whole idea. Okay, so when you say event after the reporting period, what is that supposed to mean? So let me start from the word or words reporting period. What does that mean? Now, reporting period simply means accounting year. Okay, so if you say accounting year or financial year, that's what we call reporting period. So for many companies in Nigeria, the reporting period that we are familiar with is January to December, okay, of a particular year. Okay, so that is the reporting period. Some companies, the reporting period can be from October to September, or from April to March, depending on when the accounting date or financial year that is selected, is starting from. Okay, so but basically, I'm going to use January to December in my illustration, like we agreed yesterday. So I'm going to be using 2019, okay, so that we can relate with those stuffs, right? Okay, so when you say reporting period, it's January to December, so there are 12 months calendar year. Okay, now we have what we call reporting date. Okay, reporting date is not the same thing as reporting period. Reporting date is not the same thing as reporting period, so you need to take note of that. Okay, so don't worry, the light will be restored very shortly. You need to take note of that. I told you to be restored very shortly. Okay, now sorry about that. Okay, so reporting date is also called the balance sheet date. Okay, previously, right? Now that is the last. That's the date of the last date in a financial year. Okay, so if I'm saying my reporting period of my financial year is January to December, so obviously my reporting date is December 31. Okay, so it's December 31. It's actually different from the last day of transaction. Okay, it's actually different because for a bank, for example, my accounting year end might be December 31 and it falls on a Saturday or Sunday, and my last day of transaction can be on a Friday, which will be December 29 or 30, as the case may be. So when we say balance sheet date or reporting date, obviously that's the last date, in a financial year. Okay, now we also have what we call authorization date. Okay, these are the key things you need to know. Okay, authorization date is the date at which financial statement is authorized for issue. Okay, so that means when the board of directors or the shareholders, as the case may be, have authorized that the financial statement can be made, to the public. Okay, maybe after being audited, and all of that. So when they authorize that, it can be, made known to the public. That means for a public company, for example, that's to be sent to the SEC, Securities and Exchange Commission, and probably the Nigerian Stock Exchange. Okay, so and you can also go ahead and publish it in the newspaper. So that is the authorization date. So authorization date normally comes after the reporting period. Okay, so let's say I have January to December 2019 as my reporting period. Okay, so authorization date can be 3 months after, okay, or 6 months or 5 months after, depending on a company or depending on regulation, as it were. Okay, but because of COVID-19, obviously those dates were extended so many times, in 2019, in 2020. Okay, so but for the purpose of the exams, because quite a number of us here we're writing ICANN exam, so the authorization date, we usually be stated in your question. Okay, now, so what is now event after the reporting period? There are those events that are favorable or unfavorable that occur between the end of the reporting date but before financial statements are authorized for issue. Can I say that again? Events after the reporting period are those events that are both favorable or unfavorable that occur after the end of the reporting period or reporting date, but before financial statements are authorized for issue. Okay, so what it means is this: if my reporting date or period ends in December, okay, now, and usually I authorized my financial statement to, to be made to the public around, let's say, March 31 of the following year. So in this case, it's going to be March 31, 2020. Okay. So those events that occur between January 1st, 2020 and March 38th, 2020. Okay. So that's what we call event after the reporting period. Now, we said they are both favorable and unfavorable. So those events obviously might have impact, okay, on the financial statement of the previous year that we just prepared, okay? So that's why they call it event after the reporting period, okay? Now, we have two types of events, okay? I don't really want to, explain. I don't want to spend a lot of time here, but I'm trying to also control myself, okay, so that we don't get lost or carried away here. At the same time, I needed to tell you what you need to know around the standard. Okay, now we have two types of events. We have adjusting event and non-adjusting event. Okay, so we have adjusting events and non-adjusting event. Okay, now what is adjusting event? So you have to be with me here. Okay, why? Because both adjusting events and non-adjusting events occur after the end of the reporting period. Okay, so obviously everybody understand what reporting period means and events after the reporting period. Okay, now adjusting events are those events that are indicative of condition, okay, or that provides further evidence of condition that existed at the balance sheet date. So let me say that again. Adjusting events are those events that provide further evidence of conditions that existed at the balance sheet date. So what does that mean? It simply means that some conditions or events that were already recognized or that happened during 2019 or they existed as of December 31, 2019. Okay, now in January or in February, but before financial statements are authorized for issue, certain conditions happened again that now further provide for evidence of condition that already existed at the balance sheet date. So for you to get it clearly, let me give some examples, okay? Let me give you some examples. Let's say at the year end, I have 5 customers that are owing me 100 million naira, okay? 5 customers were owing me 100 million. That means they bought my goods on credit. They have not paid, okay? So that means in my account, as of December 31, 2019, I'm going to recognize 100 million as receivables. That's the meaning, okay? I will credit my revenue and I will debit my receivables, okay? Now in January 2020, after I prepared account for 2019, I was told that one of the customer, the 5 of them together was 100 million. One of them that was owing me 30 million, for example, they told me in January or in February that they have gone into bankruptcy. Okay, so what is that supposed to mean? It simply means that event, provide further evidence of condition that existed at the balance sheet date. Okay, so when I recognize 100 million and they are telling me that one of them has gone bankruptcy, it simply means I cannot recover the money. Okay, and since I cannot recover the money that already existed at the balance sheet date, so what it means is I need to go back to that account and adjust it. That's why they call it adjusting event. Okay, so what it means is I'll go back to the last year's account and I'll adjust that figure. That means every adjusting event will lead to a change in the figures previously recognized in the financial statement. Okay, so that's why they call it adjusting event. Another example could be that in February 2020, there was a discovery of fraud that occurred in 2019. Okay, when fraud occurred, that means it involves money. Money has been moved out, but we did not know. As at the time we were preparing the account, but it's in February, maybe because of the activities of the external auditors, they're able to see those frauds. So what does that mean? That means I need to go back to that account because the fraud existed as at the balance sheet date. So I'll go there. It could be error as well, okay? It could be fraud, it could be error, okay? So I have to go back and adjust that account, okay? By writing off the fraud, okay? That means the profit for the year, we have to come down. That's the meaning. because we needed to, write off those fraud. Okay, so that is what we call adjusting event. So there are those events that provide further evidence of condition that already existed at the balance sheet date. So let's move straight away to non-adjusting event. Okay, what is non-adjusting event? A non-adjusting event are indicative of conditions that arose after the balance sheet date. Can you see now? Both of them really happened after the end of the reporting period. But when it comes to non-adjusting events, they are conditions that arose. What it simply means is it does not have connection with what happened or what existed at the balance sheet date. They are just evidence of condition that arose or indicative of conditions that arose after the end of the reporting period. But don't forget, but before financial statement are authorized for issue. Okay, so what are the examples that we can think of here? For example, in February 2020, there are major disposal of assets. Maybe we sell some of our assets, in February 2020. Okay, those conditions did not exist at the balance sheet date. Okay, so we will not go back and adjust the figures in the financial statement. At best, what we can do is to make a disclosure. Okay, so a non-adjusting event will require a disclosure in the notes to the financial statement. And when you are making those disclosures, what are you doing? You are making two disclosures: the nature of the event and the financial effects of that event. Okay, so you need to be with me here. Let me give you another example. That could be major acquisition of subsidiary after the end of the reporting period. Okay, in March 2020, we acquired a major subsidiary. It's an indicative of condition that arose after the end of the reporting period. So what I will do is go back to the last year's account and make a disclosure. It will not affect the figures in the financial statement. That's why we call it a non-adjusting event. Okay, so you can have so many other examples. They are there in your note. Okay, now be with me here. We said that an adjusting event will require that the figures in the financial statement is adjusted for. Okay, and a non-adjusting event does not require the figures in the financial statement to be adjusted for. Okay, now, but it will only require a disclosure. So I want you to start thinking, what would be the accounting treatment for COVID-19? Okay, because COVID-19, literally happened around December 2019 in China before it went around the world, starting from January 2020. So what's your take on that? Is COVID-19 pandemic treated as an adjusting event or a non-adjusting event? So if you have that answer, can you put it up on the chart? So let me see your opinion before I explain around that area. But shortly before then, let me quickly explain this in case you have grabbed your key parts to respond to that question. But take a time to listen to what I want to say now. Now, be with me here. Whenever a non-adjusting event is going to impact ongoing concern of an entity, okay? Now you have to be with me here. Whenever a non-adjusting event will impact ongoing concern of an entity, it will be treated as an adjusting event. Let me say that again, or let me explain going concern. What is that supposed to mean? If you have studied your conceptual framework properly, there is one underlying assumption in the conceptual framework, and the underlying assumption is going concern. Previously, there were two. We have going concern and the accrual basis of accounting. Okay, but the updated version of the conceptual framework has removed accrual basis of accounting to say it's now limited to one, which is going concern concept. So what does it mean? Going concern simply means when you are preparing your account, you are preparing it on the basis that there is no circumstance that you can think of that will materially alt the operation of an entity. That means you are assuming that the entity can continue to operate into a foreseeable future. Okay, that's what we mean by going concern. But once you have a problem with going concern, that means the account will no longer be prepared on a going concern basis. So how do you now prepare the account? That means you are going to use it, you are going to prepare the account on a break-up basis. That means you are planning for liquidation. That's the meaning. You are going to prepare your account based on break-up basis. So what does that supposed to mean? You prepare your assets, your liabilities, you recognize them based on realizable value. Okay, how much are you going to sell them now? That's everything. Even if you are using cost model before, it doesn't really matter. You are going to prepare them based on realizable value because you needed to liquidate. You sell them, you can settle your debt, preferential debt, and all of that. Okay, so that's the idea. Now the whole issue here is this: whenever a non-adjusting event will impact on the going concern of an entity. For example, fire caught one of the machinery in February 2020, or a major plant and machinery in February 2020. Okay, normally when fire caught a plant, okay, it does not exist at the balance sheet date, so it's a non-adjusting event. But when the fire happened, you now realize that it has damaged more than 80% of the machine, and that's the only machine you are using, to manufacture manufacture your product and all of that. So all of a sudden, you cannot fix the machine even within the next 1 or 2 years. Okay, and if you cannot fix it, that means you cannot produce. If you cannot produce, that means you cannot sell, and if you cannot sell, you cannot make revenue. So when you make an assessment and you realize that it will impact on going concern, okay, so you have to now treat it as an adjusting event. So that means you go back to last year's account and adjust it appropriately. Okay, so that's it. That's everything you need to know under IAS 10. Okay, the one last thing, or two things, let me just say two things that you need to learn is dividend. Okay, I will explain everything in this what's it called, this session. I'll just look at questions and we'll move away from IAS 10. So if you had the answer to my question that I said previously, can you put it up on the chat? COVID-19, should it be treated as an adjusting event or as a non-adjusting event? So let me have your view, okay, before I actually explain. So I want to hear from you guys. Okay, now let me explain what's it called, dividend. Okay, now dividend is the amount paid to shareholders after a particular period, okay, when the company has actually either propose or declare dividend to be paid. Okay, now the idea is this: how should dividend be treated when it comes to IAS 10? Should it be treated as an adjusting event or as a non-adjusting event? So it's possible that around November 2019 sorry, the management can declare or they can propose dividend to be paid. Okay, and in January or in February 2020, the dividend was eventually paid. It's also possible that after the reporting period, let's say in January, they also proposed dividend, and before financial statements were issued out in March, they paid those dividends. Okay, so the question now is this: in both cases or in both scenarios, should it be treated as an adjusting event or as a non-adjusting event? Be with me here. If you are a financial reporting student, you have to be with me. If you are a corporate reporting student, now you have to be with me. Either of those scenarios, anyone you are seeing in the exams, okay, whether dividend was proposed before the end of the reporting period and paid after the end of the reporting period, or was proposed after the end of the reporting period and paid before authorization of financial statement, you don't need to struggle. Anytime you see a question on dividend, okay, and that it relates to IAS 10, just tell the examiner that dividend proposed are taken as a non-adjusting event. Okay, dividend proposed are taken as a non-adjusting event. Okay, because dividend are accounted for on a cash basis. That's the reason. Okay, so anytime you see a question on dividend, don't mind the illustration, don't mind the way the examiner has tried to create problem around it. Just answer and say dividend are never an adjusting event, irrespective of when it has been paid. Okay, once it's paid before authorization of the financial statement, then it can be taken as a non-adjusting event. Okay, because they are accounted for or on a cash basis. Because the idea is this: if dividend was proposed in November 2019 and paid in February 2020, so the question is, do I have an obligation as at the end of the reporting period? That means, do I need to recognize a liability in December? Okay, so the standard says no. It has to be taken as what's it called, as a you have to treat it as on cash basis. Okay, that's what you need to know. And number two, that you need to know is this. If IAS 10 is not applied properly, it can lead to window dressing. I tried to talk on window dressing the other day. That was in our previous session. Okay, you know what window dressing is, Abi. Window dressing is an attempt to artificially improve the reported profit of an entity. So how can you use IAS 10? These are the technical questions that corporate reporting students should be expecting. But for financial reporting, the examiner may not bother you around here. But you having the knowledge is not out of place. So the examiner can ask you, how can IAS 10 be used, to window dress the account? Okay. Now, shortly before the year end, because now have you noticed? Let me lay this background before I explain that. Have you noticed that when entities are reporting their performance in the year, they normally do it on a quarterly basis, especially for public companies. Let's say January to March, they do their account. From April to June, the same. 3 months to the end of the year. Have you ever noticed that the performance, let's say revenue, keeps increasing every month? Every quarter rather? Have you ever noticed? Okay, it keeps increasing. Although there might be reasons for that. Maybe between January and December, people are just recovering from what's it called, the spendings in December, the new year and all of that. And between April and June, maybe the business is just picking up. Okay. And between July, August, September, maybe that's when the business has now really picked up. And towards the year end, it might be assumed that people are now buying more. That's why it keeps increasing. But if you really look deeply, it's not really the case for every company, especially for seasonal product company, base company. Okay, now what happened? Why is it that towards the year end, the revenue is usually, in fact, it can double the whole of the revenue we have made from January to let's say September, for example. Okay, now most times it's actually window dressing. For example, they might decide to start raising invoices for goods that were not ordered for. That's what they call channel stuffing. Okay, they start raising invoices. They start supplying suppliers even though they did not ask for them. Okay, because they know that you can go ahead and recognize revenue on credit sales. Okay, why? Because they want to improve their reported profit. And after the reporting period, okay, around January or February, they will reverse those transactions. That's it. That's the way IAS 10 can be used. If it's not applied properly, to actually window dress the account. So that's the kind of technical question that you should expect from the examiner. Okay, I didn't really plan to tell you all of this, but I think you needed to know them. Okay, so let me see. I think I have some comments whether COVID should be treated as an adjusting event or a non-adjusting event. Okay, after I was saying it should be an adjusting event. Okay, fantastic. Vivian says an adjusting event in as much as it's affecting the going concern or the business. Okay, Fatima is saying it will be treated as an adjusting event if it threatens the going concern of the company, but if it's not, it is a non-adjusting event. I love these responses. It really means you guys understood the concept. Okay, that's fantastic. That was exactly my point. When even before what's it called, the ISB, they met for to decide whether COVID-19 should be taken as a non-adjusting event or as an adjusting event. So the answer is very straightforward. If COVID-19 has impacted on your business severely and you're thinking that your going concern has been threatened, obviously it's going to be an adjusting event. Okay, but if it has not threatened your your existence, your going concern, for example FCA, for example, we are going to take it as a non-adjusting event. It's pretty simple. Okay, but the result of ISB was that COVID-19 should be taken as a non-adjusting event. Why? Because for most entities it doesn't really affect their going concern. Okay, that's brilliant. Thank you for your for your responses. So I've explained every other thing that is here. So let's look at this question to further solidify our understanding on IAS 10. Then we'll look at one other one, then we move away. Now the example here is saying, shortly before the reporting date, a major credit customer of a company went into liquidation because of heavy trading losses, and it's expected that little or none of the 12,500 debt will be recoverable. 10,000 of the debt relate to sales made prior to the year end, and 12.5 relate to the sales made in the first 2 days of the new year. In the 20X1 financial statement, the whole debt has been written off, but one of the directors has pointed out that as the liquidation is an event after reporting date, the debt should not in fact be written off, but disclosure should be made in the note to financial statement, and the debt will be written off in 20X2 financial statement. Required, advise whether the director is correct. So when I see this kind of question, how do I approach it? Okay, like I always say, don't solve question the way you feel it should be solved. You have to go back to the standard. What's the standard saying about it? Okay, and that's exactly the way you go about a question. Okay, now so let's find out. Now everybody already knew that this is highest 10 because he said even the comment of the director where it says an event after the reporting day. So we already know is highest 10. So what happened? He said one of our customer that was owing us 12,000 debt, okay, went into what's it called, liquidation. Can you see that? It went into liquidation, and that money will not be recoverable. So what it means is we need to write it off. Okay, so what do we do now? The examiner now told us that 10,000 of the debt relate to the sales made prior to the previous year. That is 20X1. Okay, can you see the point? Now 2.5 of the debt, 2,500 naira of the debt relate to the current year. Sales made in the first 2 days of the current year, which is 20X2. So you have to get that correctly. Once you get that correctly, that understanding correctly, you are good to go. It now said in the 20X1 financial statement, can you see the old debt was written off? Is this correct? It is not correct. Do you know why? 10,000 relates to 20X1 and 2,005 relates to 20X2. So why are you writing off all the money in 20X1? So it's not correct. Okay, now the director now says no, it should not be done that way. That since the event the liquidation that occurs after the reporting date, the old debt should be written off. The old debt should not be written off. Okay, so this is what this guy is saying. He said the old debt should not in fact be written off, but a disclosure should be made, and the whole money will now be written off in 20X2. Even the directors is also not correct, and these are the kind of scenario that accountant faced in the real life cases. Okay, your management, your MD can put you under pressure that in the current year's account, debt that are supposed to be written off, can be delayed into the future year. That's what this guy is saying. That should not be written off. It should only disclose it. Then in 20X2, it should be written off. But it's not correct. The director is not correct. The way that's also been treated is not correct. So how are we supposed to do it? The 10,000 that relate to 20X1, and we have the information at the beginning of the new year, but before financial statement is authorized for issue, is going to be written off. Why? Because it's an adjusting event. It provides further evidence of condition that existed at the balance sheet date. And for the 2.5 that relate to the 2,500 that relate to the current year will be written off in the 20X2 financial statement, but we can make a disclosure if we like, because it doesn't even relate to the previous year's account. Okay, but if you like, you can make a disclosure. Okay, so that's it. That's the end of that question. It's very straightforward. Okay, so that's the way the examiner can take you on that. Let's quickly look at this classwork. Okay, so here you are going to determine whether it's an adjusting event or a non-adjusting event. The insolvency of a major credit customer. Although we are not giving further information here, okay, because I can have a customer that is owing me at the beginning of the year and he was insolvent, at that same year. So, okay, but let's assume on a normal day, okay. So the insolvency of a what's it called? A major credit customer is an adjusting event. Do you agree with that? Okay, you should. Okay, the uninsured loss of hire in inventory, uninsured loss of inventory in fire. Okay, now this is also a two-way thing. Okay, naturally, when you look at it, it's a non-adjusting event. Okay, but if it's going to impact ongoing concern, obviously, it's going to be taken as an adjusting event. The proposal of a final equity dividend. I've told you, anytime you see dividend, don't even bother yourself. Once it relates to IS 10, you just take it as a non-adjusting event. A change in foreign exchange rate, obviously, this is a non-adjusting event because it's not really a condition that existed at the balance sheet date. So I've explained dividend to you. Okay, so let's look at this question and we say bye-bye to IS10. Here, there's usually a lead time between the end of the accounting year and when financial statements are approved and signed off by the directors. In between this period, there are two types of events, according to IS10, which may require consideration when preparing financial statements. Required, identify and explain these events and show how they are treated in the financial statement. If you have been listening to me since we started, you should be able to handle this scenario, okay? You should be able to handle this scenario. I said identify and explain. You identify them, adjusting and non-adjusting. Then explain. Can you see? You have to follow the requirement. An adjusting event are those events that provide further evidence of conditions that existed at the balance sheet date. Then go ahead and give the examiner about 2 to 3 examples. Go ahead to explain non-adjusting event as well. They are indicative of conditions that arose after the end of the reporting period. Then give examples. You now said, how are they treated? So that means in your explanation, when you're explaining the adjusting event, you tell the examiner how it should be done. Okay, that means to result into changing the financial the figures in the financial statement. But for a non-adjusting event, it will only require a disclosure where you disclose the nature of the event and the financial effect of that event. Okay, that's it. You earn your maximum marks if you can do that. Okay, then you move to part B of that question. So what's this one say? It said company A is indebted to company B to the tune of 50 million. The financial year end of company B is 30th June 2014. On 30th July 2014, the company B received a letter from a liquidator advising that company A has gone into insolvency. The letter revealed that company A ceased operations a month ago and that company B is only likely to receive a liquidation dividend of 20 kobo for every naira held by company A. It is normal practice for companies B board to approve the audited financial statement 3 months after the financial year. Can you see? So they will always tell you when financial statements should be will be approved, authorized. Okay. So let's look at the question and answer required. Explain how the above transaction should be treated in the financial statement of company B in accordance with IS10. Events after the reporting period. So how should this transaction be treated? Okay, do you agree that this transaction is an adjusting event? So let's find out. Let me try to break that question down for you. He said company A is indebted to company B. Okay, so company B is actually expecting this money, which is what's it called, 50 million, and the year end of company B is June 2014. So in July, can you see 2014, just a month after, we now receive a news that this guy that was owing us 50 million has gone into bankruptcy, and this 50 million already existed at the balance sheet date. That's it. Okay, and he said the guy ceased operation a month ago. Okay, now out of this 50 million, how much can we recover? They said we can only recover 20 kobo for every naira. Okay, 20 kobo for every naira. So that part A was saying how will it be treated? Obviously, we are going to adjust the financial statement. Okay, we are going to write off is it the whole 50 million? No, because we're going to recover 20 kobo. So how do we calculate that? Okay, let me try and get my calculator from here. Okay, this calculator is impaired. Okay, it's on now. Okay, now if it's impaired, I'll just classify it as held for sale according to as far as 5. Okay, now, so how do we do that? So this is 20 kobo for every naira. So what do you do? So just convert the kobo back to naira by dividing it by 100. So when I divide by 100, I have 0.2. Okay, that's 0.2 multiply by 50 million, so that I can get how much. Let me see how many zeros is 50 million. Okay, so that means I will recover 10 million. That's the meaning. So you can press your calculator if you are there. So I need to write off 40 million. Okay, so when you explain to the examiner, you just tell the examiner that 40 million is going to be written off. Okay, so that's part A of that question. In the part B, or I said prepare journal entry that are required to adjust the company's financial statement to account for the above event. So what's your journal entry? You know it's receivables. I've already credited my debited my receivables. Okay, so what will I do? I will debit P or L account. That's bad debt written off. Okay, and I will credit my receivables by 40 million so that I can reduce that 50 million to 10 million because that's what I can, really recover. Okay, so that's what that is saying. Then in the part 3 of that question, it's saying state what would have been the treatment in the financial statement, assuming that it was fire that destroyed company's B factory factory building on 30th July 2014. So if it was fire, it will be taken as a non-adjusting event, provided it doesn't have impact on the going concern of the entity. That's it, because you understand you are just having a smooth ride in your exams. Okay, and part C of that question is talking about dividend. Okay, said the directors of XYZ PLC declared dividend of €1, blah blah blah. You don't really need to waste time. Once you read it, you forget all those dates and all of that. You just want to confuse you. Just tell the examiner that dividend are taken as a non-adjusting event because they are accounted for on a cash basis. It's as simple as that. Okay, so you have your answers there. So when you have your time, you can go through them. Okay, they are very straightforward. Okay, so this is the journal entry we are saying the other time. Can you see that? Okay, so that's it. Okay, right, and this is summary of IAS 10. Can you see? This is a summary. Okay, so you don't need to draw this for the examiner, just for you, when you are doing your revision. Okay, so you can see this, and even in practice, this is what you do. Okay, event after reporting period, event that occurred after the end, of the year, after year end, but before financial statements are authorized for issue. So here it gives evidence of condition that existed at the balance sheet date. Can you see that? And here you are going to adjust the financial statement. Here you say it gives new evidence of condition that arose, that did not exist at the balance sheet date. So what do you do there? You have to only disclose the nature of the event and the estimate of the financial effect. Okay, but if it impacts on the going concern, can you see? It will become an adjusting event. So you adjust the financial statement. Okay, so that is it. Now, Now, if you are also writing, what's it called? Advanced audit and assurance, IAS 10 is also very key for external auditors. Okay, because the only way they can actually test, well, I just told you that shortly before the year end, entities can decide to, raise invoices so that they can improve their performance. Okay, and after the year end, they reverse them back. So when an external come on board, the external auditor is interested in those transactions shortly before the year end, and those transactions at the beginning of the new year end. So they perform a test that we call roll forward test and roll backward test, and they also do what we call cutoff procedures. Okay, they do pre-cutoff test and post-cutoff test, and the objective is to ensure that the transactions that relate to a particular accounting year are also accounted for in that accounting year. Okay, so in case you are doing audit, that can be an idea for you. So you need to understand this standard, and that's the end of IAS 10. So you have some practice questions over there that you can go through at your leisure. Okay, so this is we were supposed to do that yesterday, but time was not on our side. Okay, so let's now look at IFRS 16. Or do we need to take some tea break? Sorry, we are not taking tea break, but you can take tea over there. But me, I cannot take tea. So let's just continue. So let's start IFRS 16. Leases. Okay, this is a very new standard. It came on board in 2018 from January 1st, and it's superseded by what's it called? IAS 17 leases. I think yesterday I was able to differentiate between IFRS and IAS. Okay, and we also looked into SCS. Okay, so you know why this is IFRS 16. Okay, so you know. Okay, but in case you don't know, once you watch that video for yesterday, you will be able to know. Okay, now basically every company, in fact most companies, they have some assets they were leased. Okay, they have some assets that are on lease. Okay, so I have a question here. Let me quickly deal with that question. It said, please, how do I know if it impacts on going concern of the entity? Yeah, obviously it's very straightforward. I think I gave example on okay, if you are referring to the question, let me try to understand that question. If you are referring to question scenario, the examiner will always tell you. But when the examiner is silent on impact on going concern, then you assume that it will not impact, okay? So you treat it as a what's it called, as a non-adjusting event. If you are sure that that example is, for example, fire cutting a plant in February, okay, after the year end, naturally, it's a non-adjusting event, okay? But the examiner has stated that it's going to impact on going concern by giving you a scenario, okay? For example, they can say the company may not be able to work for the next 2 years. Obviously, that impacts on their going concern, okay? But if it's a life case scenario, obviously you will know, the accountant will always know when preparing the account that, hey, this account we want to prepare, we know we cannot exist into a foreseeable future. Or even if the account has been prepared on a going concern basis, and there was COVID-19 pandemic. So all of a sudden, the operations, are going down. Do you know that some international companies like, what's the name of this airline? Is it Virgin Atlantic? They are filed for bankruptcy because of COVID-19, okay? So you expect a lot of companies in the airline to also go under the carpet, especially if there is no, Virgin, thank you, Virgin, So if there is no bailout fund from the, from the government, okay? So most of them, because, before COVID, you know that for international flights, people book as far as 1 year ahead. Yeah, we have some people working in the aviation here, okay? You can bear me witness. For international flights, okay, you book as far as 1 year ahead. So a lot of people are booked into 2020 as at December 2019. And all of a sudden in January, you cannot fly again. So what happens to those money? And especially for international flight, the exchange rate, the dollar and the UK is a lot of debt. How do they pay back? And whether you fly or not, we have aviators here. Whether you fly or not, there are some compulsory checks you must do on aircraft, or you must carry out on those aircraft, the C check, D checks, and the like, whether you fly or not. Okay, the tire of an aircraft has a minimum lifespan. It's not until, like our car now, until this thing is coming out before you change the tire. It's not like that in the airline. Okay, it has the minimum cycle. Okay, and the higher of the two, I can't really think. Maybe I can remember those stuff. So those are the ideas. But obviously, when you are preparing your account, to know. Okay, but in a scenario question, in an exam question, obviously, the examiner will tell you, okay? Thank you for your question. Okay, so let's quickly look at leases. As I was saying, in fact, leases, most companies, they do leases, especially in the airline as well, because most of those aircraft, they are not really the owner, okay? Most of them, they call it wet lease. They are wet lease. Now, be with me here. There's an idea around here. So let me quickly tell you. The major difference between IFRS 16 and 17 was that IFRS 17 is treated as off-balance sheet financing. So what does that mean? It simply means if I have a lease contract, it doesn't reflect in my financial statement. I take it off balance sheet, okay? So there were debates around the world that it doesn't reflect transparency, and the financial statement will not show a true and fair view of the financial transactions that has taken place, because leases are not treated as on balance sheet, okay? So that's one of the reasons for an amendment that was made to IFRS 17 and IFRS 16 was issued, to now state that leases will now be shown in the financial statement, okay? So, and the impact is that my gearing level will go up. So what do you mean by gearing level? It's just the ratio of my debt to my equity, okay? If I borrow money to finance my operation, my gearing, that's they say the company is highly geared or geared. Anyone, just pick one, okay? Whether geared or geared. So when they say a company is highly geared, that means the ratio of debt to equity is higher. That's the meaning. And the company might be at a risk of insolvency, okay? But normally as an accountant, that's not usually the case, okay? But because we are not going to look at ratio analysis here, I would have told you so many things around that here. The fact that, let me quickly say that, the fact that a company is highly geared, it doesn't necessarily mean the company is going to collapse, okay? You have to check the nature of the company, okay, or the nature of the business, okay, to determine whether the company is at the risk of being collapsed. For example, if you go to these companies that deals in heavy trucks, like tractors, like bulldozer and all of that. Even some of the airlines, most of the airlines really, okay, you know, because those businesses, they are capital intensive. So no one person can really put funds together to acquire those assets, okay? So most times it's either they borrow money to acquire them, or they are on lease, okay? So if you look at those companies, at a point in time or at every point in time, their account is, you know, is showing that they are highly geared, they are highly leveraged, okay? So in that case, it doesn't really mean that they are at the risk of collapse. It's just because of the nature of the industry, and that's why you are a chartered accountant. So those are the things you need to know, okay? So now the implication of IFRS 16 being treated on the face of the financial statement is that it's going to have impact on my gearing, okay? So a company that has so many lease contracts, let's say before 2018, and needed to apply IFRS 16 from 2018, obviously it will have impact on the gearing position. So in case the examiner is holding you around that area to explain the impact of IFRS 16 on the financial statement, just remember that it's not taken as an on-balance sheet financing, and it's going to have impact on the gearing position of an entity, because you are now need to disclose it, okay? So let's move on. So now what is, sorry, so let's look at some key definitions. There is something we call interest rate implicit in the lease. And there's something we call, what do we call it? Leases incremental borrowing rate, okay? Don't bother yourself about the definition. Nobody will bother you here, okay? But you need to know it, okay? Because those are the interest, the cost of capital we're going to use, okay? When solving questions. Now, the interest rate implicit in the lease is the rate that yields the present value of the lease payment and the unguaranteed residual value that equal the sum of the fair value of the underlying asset and the initial direct cost of the leasehold. You have that in your note, okay? Like I said, don't bother yourself. But when they say interest rate implicit in the lease, that means the interest rate has been calculated, okay? And it is directly attributable to the lease arrangement. That's the meaning, okay? Now, when we now say leases incremental borrowing rate, what does that supposed to mean? If the interest rate implicit in the lease cannot be determined, then we now go ahead and determine the lease's incremental borrowing rate by looking at what will be the cost of capital that the lessee we borrow money to buy or to acquire a similar item under the same condition. That's the meaning. So let's assume, so in this scenario now, I will assume that you are the lessor, I am the lessee. I'm going to explain lessor and lessee and lease contract to you very shortly, but let's say you are the lessor and the lessee. So when we have a contract together, you want to hire, I want to lease your, let's say, Keke Marua, okay, so I want to lease it from you, and we cannot immediately determine the interest rate implicit in that lease, okay? So we can use leases in incremental borrowing. That means me, being the lessee, I can look at, okay, if I'm not leasing this property from you, and I go elsewhere, maybe to the bank, to borrow money, and you know, to use that money to acquire that same asset, okay? What would be the cost of finance or cost of capital that I'm going to pay, okay, in getting that money and acquiring that same asset, okay? That's what they mean by leases incremental borrowing rate. Now, be with me here. The examiner can never give you those two rates in an exam question. But in case you were given, you know, sometimes the examiner can just, you know, try to dribble you, okay? You have to take leases, what's it called? Interest rate implicit in the lease, okay? So, for example, the examiner can say the interest rate implicit in the lease is 5%. And the leases incremental borrowing rate is 6%, okay? Just ignore leases incremental borrowing rate and pick the 5%, okay? Now, but if the examiner gives you either of the two, okay, they can give you interest rate implicit in the lease. So you don't need anybody to tell you that you have to use that figure, okay, or that percentage. Then they give you leases incremental borrowing rate, and you were not given interest rate implicit in the lease. So go ahead and use leases incremental borrowing rate. But in most questions, the two of them will not appear. Just use either of them that appears. But in case the two of them should appear, then you have to take the interest rate implicit in the lease, okay? So, but for I've told you, even if you are writing financial reporting, you don't need to cram or, you know, those definitions, okay? Now, what is a lease? A lease is a contract or part of a contract that conveys the right to use an underlying asset for a period of time in exchange for consideration, okay? A lease, can you see that? Is a contract or part of a contract. So that means I can have a contract that part of it is a lease and the other part is not a lease, okay, that conveys the right to use an underlying asset for a period of time in exchange for consideration. So who is a lessor? We have agreed that you are the lessor, so I'm the lessee. The lessor is the entity that provides the right of use asset and in exchange receives consideration, okay? The right of use asset was not in IAS 17, okay? So this is a new concept that IFRS 16 is bringing on board. So if you pick up a financial statement of an entity and under the non-current asset, you see right of use asset, it simply means they have some contracts that are leases. I think I've told you, okay, I've tried to also told you some specific requirements in accounting standards that once you pick up the financial statement and you see those narration, you already know what it is. For example, if you see biological assets, that is IAS 41, agriculture, okay? If you see assets held for sale within the within current assets, it simply means IFRS 5 has been applied. If you see right of use assets, it simply means what's it called? It simply means IFRS 16 has been applied, okay? So a lessor is an entity that provides the right of use asset, in exchange receives consideration. And a lessee is also an entity that obtains the use of the right of use asset and in exchange transfers consideration, okay? So you might bother yourself to know this definition in case the examiner will ask you. And the right of use asset is the lessee's right to use an underlying asset over the lease term. Okay, now how do we now identify whether a contract contains a lease? So you have to be with me here. This question was tested in November 2019. That was part of number one question. Okay, I remember that I was just dancing around. Identifying a lease in the class. Okay, so and that's what came out. So I kind of never tested the calculation part of IFRS 16, so you might expect it this diet. And IFRS 16 has never been tested in the financial reporting, so you might also expect it because COVID-19 is also having impact on IFRS 16. Why? There was an amendment that was done to COVID, that was done to IFRS 16 in May 2020, just a few months ago. Okay, because of COVID-19. So we're going to find that. I'm going to be showing you that, okay? So now, how do you identify if a lease or if a contract contains a lease? So you have to be with me. A contract will contain a lease if it conveys the right, okay? It conveys the right to control the use of an identified asset for a period of time in exchange for consideration, okay? A lease or a contract contains a lease if it conveys the right to control the use of an identified asset over a period of time in exchange for consideration. For this to be the case, two things must happen. When you hear the word control, something must come to your mind. Normally, naturally, I think I explained that yesterday when I was explaining available for immediate sale in its present condition. It simply means the entity has control, okay, and can prevent any other person from gaining the same economic benefits from the asset. That's the meaning. Can you remember? Okay. Now, for this to be the case here, when we say a contract contains a lease, when it conveys the right to control the use of an identified asset for a period of time in exchange for consideration, it simply means substantially all the economic benefit associated with that asset will flow to the lessee. Okay, that's the first thing you need to learn. And number two, the lessee has the right to direct the use of that asset. Okay, can you see the point? So two things will happen before you can know whether a contract contains a lease or whether a contract that contains a lease has actually conveys the right to control the asset. One, substantially all the economic benefit will flow to the lessee. And number two, the lessee has the right to direct the use of that asset. IFRS 16 now went again to further explain the directing or the use of an asset. What does it really mean? It said if the lessor put a capping, on that asset, okay, it doesn't still prevent the lessee from directing the use of the asset. So let me come back to the example I was giving the other time. We have a contract together, and you gave me your Keke Marwa under a lease contract, okay, and you now told me by saying every month I should not use more than 1,000 mileage, okay, that is the capping that the what's it called, IFRS 16 is saying. You have put a capping, around the usage of the Keke Marwa. But in the real sense, it does not really prevent me from directing the use of the asset, okay? I can take it anywhere I want. I can take it to Lekki, I can take it to Aja, I can take it to Ikorodu, okay? The only thing you have said was, I should not use more than 1,000 mileage per month, okay? So what you have done is part of the scope of the contract. That's what IFRS 16 is saying, okay? So once I can direct the use of that asset, okay, that means the contract contains a lease. However, now be with me here. However, if the lessor has the practical ability to substitute the asset for another one, and it's going to be economically beneficial for them to do so, that means the contract does not contain a lease. Can I say that again? However, if the lessor, you are the lessor now, you can substitute your Keke Marwa and give me Okada. That's the meaning. Okay? You can substitute it, and it's going to be practically, economically beneficial for you to do so. Then the contract does not contain a lease. Okay? That's what you need to learn. And that was exactly what I can ask the last time, the very first time. That was November 2019. Yeah. Okay. So that's what they just had. So if you can explain those things to the examiner, then you get your maximum point. Okay. So I've explained all of that. Okay. Let's find out. Yeah, I've explained all of that. Okay. Now IFRS 16 are added to the fact that contract with a short life, okay, that means they are less than 1 month, 12 months, 1 year, okay, they may not be treated as lease, okay, and if those contracts have low value, okay, they have low value. What's it called? The standard did not tell us what is low value, but it gave us some example. For example, tablets, small computers, telephones, small item or furniture. Okay, these are the examples that IFRS 16 is giving us. But obviously, we said IFRS is principles based. Now, if your company is leasing tablets, and for example, you have, let's say, 5,000 workforce, okay? If you have about 5,000 workforce, and you're leasing the tablets they'll be using to work, it might be significant. Okay, it might be significant. Sorry. Now, so what that means is you have to also apply judgment around that area to determine whether those contracts contains a lease. Okay. Okay, I have a question here, please. What is the difference between rent and lease? Okay, I was expecting this question. What is the difference between rent and lease? Now, within the context of the accounting standard, once you have a rent, okay, or you get an apartment, and when you are paying, it's just 1 year, that is rent, okay? But once it's more than 1 year, like just in the context of the accounting standard, it becomes a lease. That's the meaning, okay? It becomes a lease, okay? So rent is usually for a shorter period, but before now, normally if you rent, pay for 2-3 years, they still call it rent. But once it's becoming 5, 7, 99 years, for example, you see some companies, the building they are using or the land, it was rented for 100 years or 99 years. So once you have, that's why they call it lease. It's a long lease. You can't call that one rent again, okay? But because of this illustration, the IFRS 16 is giving us that to say once it's less than 12 months from the inception date, then you take it as rent. That's the meaning, okay? But once it's more than that, then you take it as lease, okay? So I think that's clear, right? So I was expecting that. That's brilliant. That means you are following, okay? Now, so that's what you need to know. So let's look at this example to demonstrate whether what I've explained, we know that. Okay, it said Cough Bean enters into a contract with an airport operator to use some space in the airport to sell its goods from portable kiosk for a 3-year period. Okay, now Cough Bean owns the portable kiosk. The contract stipulates the amount of space and states that the space may be located at any of the several departure areas within the airport. Okay, Now, the airport operator can change the location of the space allocated to Coffee Bean at any time during the period of use, and the cost that the airport operator will incur to do this will normally be minimal. There are many areas in the airport that are suitable for the portable kiosk. Required, does the contract contains a lease? Okay. Now, when I have this question in my front, I don't need to start thinking, does the contract contains a lease? I just remember the principle in my head, okay? Because we said, or IFRS 16 state that a contract contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. So that means I can control the use of an identified asset. Then I ask this question, where is the identified asset? Then where do I demonstrate control? Okay, so it said Coffee Bean enters into a contract with an airport operator to use some space. Can you see? To use some space in the airport. Space is not an identified asset. So this is not a lease contract. That's it. Space is not an identified asset. According to IFRS 16, instead, it's just giving me space so that I can put my kiosk there for 3 years. Okay. Now, that is not the end. You know, he also said, before you can have the before a lease contract conveys the right to control the use of an identified asset, he also said two things will happen. Substantially, all the economic benefit will flow, and the lessee has the right to direct the use of that asset. In that sense, a contract does not contain a lease if the lessor can change the assets, and it's going to be practically economically beneficial for them to do so. So now said, Coffee Bean owns the kiosk. Oh, that's fine. So the contract stipulates the amount of space, and said the space may be located. Can you see? It can be located anywhere in the departure area. So the airport operator can also change the location of the space at any time. That's it. And he said it will be minimal. The cost to be incurred is going to be minimal. So obviously, from those evidences from the question, the contract does not contain a lease. Okay. So can you see the way we approach that question based on the principle? Okay. So let's quickly look at the second one before we move to the calculation part. I will show you the COVID impact. I will move away from IFRS 16. Okay. Now, AFG enters into a contract with Splash, the supplier, to use a specified ship. So here, there's an asset, okay? Okay, so they said ship, okay? Now, for a 5-year period, can you see? And we said a contract contains a lease if it conveys the right to control the use of an identified asset for a period of time. Can you see? So that's a period of time, okay? And in exchange for consideration. Okay, so Splash has no substitute right. Can you see? They cannot substitute the asset. So this is telling me that most likely this contract will contain a lease. Now said, during the contract, AFG decide what cargo will be transported, okay, when the ship will sail and to which port it will sail. So what is that supposed to mean? That means AFG can direct the use of the asset. Can you see now? It can direct the use of the asset. However, there are some restrictions specified in the contract. Those restrictions prevent AFG from carrying hazardous, hazardous material into the cargo, or from sailing the ship into water where privacy is a risk. That is a capping, okay? It forms it's part of the scope of the contract. That does not still prevent AFG from directing the use of the asset. Okay, so it said Splash operates and maintains the ship and is responsible for safe passage. AFG is prohibited from hiring another operator and from operating the ship itself during the term of the contract. Required does the contract contains a lease. So I'm sure you know the answer by now. Obviously, the contract contains a lease. So you can see the answer there. I've tried to analyze it for you. So let's now go to the accounting. Okay, the accounting side. Lease is very simple. If your company has a lease contract, anything you take here from here, just go and formalize it on Excel sheet. Okay, the figure you get there, you just take it into your financial statement. Okay, you're fine. Okay, that's it. It's very simple. Now, this is the basic principle. okay? Leases accounting, you know, this is the new aspect that IFRS 16 is bringing on board. It said at the commencement of the lease, IFRS 16 requires that the lessee must recognize a right of use asset and a lease liability, okay? At the commencement of the lease, the lessee, everybody know who a lessee is. So in this scenario, I'm the lessee because I want to use your, I want to lease your keke, Marua. Is that okay? So the lessee, me now, I must recognize a right of use asset and a lease liability on initial measurement. So everybody should be familiar with what is called initial measurement. That means the first time I'm accounting for this lease. That's the meaning, okay? So when you say initial measurement in the financial statement, that's also the first time you're recognizing a particular item in the financial statement. So on the initial measurement, so let's now look at the two. You know, we said at the commencement of the lease, the lessee must recognize a liability, a lease liability, and a right of use asset. So at the commencement, okay. Now on initial recognition, so let's look at the lease liability. The lease liability must be initially measured at the present value of the lease payment that has not yet been made. So let's assume that you said your keke that you want to lease out to me is 1 million. That's a lease contract, okay? Now, you know that 1 million will be paid over 3 or 4 years. That's the meaning. I'll pay the 1 million over 3 or 4 years, and those 1 million is in the future, okay? So the standard is not saying it has to be measured at the present value, okay, of the lease payment that has not yet been made. That's what you need to know. You have to put that in your head because the examiner can ask you to explain the basic principle around lease accounting, okay? So what you do, tell the examiner at the commencement of the lease, IFRS 16 requires that the lessee must recognize a lease liability and a right of use asset. And on initial measurement, the lease liability must be measured at the present value of the lease payment that has not yet been made. So what will be the discount factor that I'm going to use? I will use the interest rate implicit in the lease. Can you see now? When the examiner did not give me interest rate implicit in the lease, I will use the lease's incremental borrowing rate. That's simple. Now, what now constitutes my lease payment? According to IFRS 16, 5 things constitute my lease payment. Number one, fixed payment, okay? Number one is fixed payment. So if the contract is 1 million naira, that one is fixed, okay? So I'm going to consider that. Number two is variable payment that depend on an index or rate, okay? That's variable. That means that variable payment can be dependent on some economic condition if it forms part of the contract. So most likely it will not even form part of the contract. Number two or number three is the amount expected to be payable under residual value guarantee. So what does residual value guarantee is? If both of us we enter into a lease contract and I promise you that this asset, that's your keke marua that you are giving to me, will not worth more less than a particular amount of money at the end of the lease term. For example, I can promise you and say at the end of the lease term, your keke marua will still worth around 100,000. That's the meaning. That's the residual value guarantee. Okay, if it forms part of the contract, I'll add it together. And number four is the amount expected to be, options to purchase the assets that are reasonably certain that is going to be exercised. So if there's an option within the contract that at the end of the lease contract, I'm going to purchase the asset. And number five, which is the last one, is termination penalties, okay? Termination penalties. That is, if the lease reflect that the expectation that this will be incurred. That means maybe during the period I decide to also terminate. So what will be the cost? Okay, so we take all of them together and we discount to present value. But in your exam scenario, obviously you won't see all these 5, but you need to learn all the 5 because the examiner can play around any of them. But obviously you're going to see fixed payment because that's what what the lease is actually all about. So you you ask the question, where is my fixed payment? It's going to provide it for you. Is there any variable payment here? It's going to tell you, okay? Now, is there any amount that is expected to be payable under residual value guarantee. So the examiner may not use the word residual value guarantee, but once they say that lessee's promise that the worth of the asset will not be less than a particular amount, that is the residual value guarantee. Then options to purchase the asset, if it's reasonably certain, is going to be exercised, and the termination penalties. 5 of them contains my lease payment, then I discount to present value. It's as simple as that, okay? So let's now go to the right of use assets. We said at the commencement of the lease, the lessee must recognize the lease liability and a right of use asset. And the lease liability has to be discounted to present value, but that's the lease payment that has not yet been made. So what constitutes my right of use asset? On initial recognition, the right of use asset must be recognized at cost, okay? So what constitutes the cost of the right of use asset? That's the initial cost of the right of use asset. There are 4 of them, okay? Number 1, the amount of initial measurement of the lease liability. So what it means is this: the amount that I got after discounting the lease liability to present value will be the number 1 component of my right of use asset. As I'm recognizing the lease liability, that same amount, I will debit my right of use asset. That's the meaning, okay? So the amount of the initial measurement of the right of use asset. Number 2, lease payment made or at the commencement date. It's possible when we are entering into those contracts, maybe there are some costs that I made at the beginning, okay? You can just say you want some advance payment, okay? Maybe I make it at that beginning. It also form part of my right of use asset cost, okay? And number 3, initial direct cost, okay? And number 4 is the estimated cost of removing or dismantling the asset. It's possible that asset involves a mask or, all these big assets that requires, installation, right? Yeah, that requires installation. Maybe at the end of the lease, that should be removed, okay? So what's the cost I'm going to incur? So that's the estimated cost of removing the asset. So the examiner can feature any of these in the exam, but obviously they may not feature the number 2, 3, and 4, okay? But the initial measurement obviously is natural, and maybe the initial direct cost, okay? So what is now my lease term, okay? So you have to also be with me here. The lease term, so normally the examiner may not tell you straightforward that the lease term is 4 years or 5 years. They might decide to dribble you. So how do you know my lease term? Number 1 is the non-cancelable period, okay? Non-cancelable period. What's the meaning of non-cancelable period? If we enter into a lease contract, what is the original period for that contract? So it could be 3 years, it could be 4 years, it could be 5 years. That is the non-cancelable. That means it has to run, at stretch for that period. For example, if I rent your land or I lease your land for 99 years, that is the non-cancelable period, okay? Number 2, period covered by an option to extend the lease if reasonably certain is going to be exercised. So when we are doing the contract, we can also say, okay, after 5 years, you can extend it by extra 1 year. And if it's reasonably certain that we exercise, it forms part of my lease term, okay? And number 3, which is the last one, period covered by an option to terminate the lease if reasonably certain that it will not be exercised. I will also consider it. But obviously, you can't see this all 3 in the exam, but you can see, obviously, you see the non-cancelable period and either of those other periods, okay? So that's what you need to learn. Once you have learned that properly, then you can solve any question. So let's find out, okay? Let's look at this question. It said, on 1st January 2021, Dynamic entered into a 2-year lease for a lorry. Sorry, the contract contains an option to extend the lease term for a further year. Dynamic believes that it is reasonably certain that the option will be certain to exercise this option. Lorries have useful life of 10 years. Lease payments are 10,000 per year for the initial term and 15,000 per year for the period, for the option period. All payments are due at the end of the year. Okay. Now, to obtain the lease, Dynamic incur initial direct cost of 3,000, and the lessor immediately reimbursed 1,000 of this cost. The interest rate within the lease is not readily determinable. Dynamic incremental rate of borrowing is 5%. Okay. Required. Calculate the initial kind amount of the lease liability and the right of use asset and provide double entry needed, to record this amount in the dynamic financial record. Okay. Anytime you are testing list questions, you will always know because they will mention list around that area. I think I have a question here. Let me look at that. It said, how do you treat a land lease for 30 years period? A land lease. Treat for 30 years period. Yeah, you will know now. Yeah, let's do this. Okay. So let's do this. You follow the same principle for every type of asset. Okay. So you're going to know now. All right. Thank you. Okay. Now, so when I had this question, it said, what would be the initial kind amount? And I know that's by IFRS 13. I have to recognize two things. Okay. The lease liability and the right of use asset. Okay. I need to do that. So like the question that was taken there, here it said dynamic enter into a 2-year lease for lorry. So it could also be 30 years lease for land. Okay, so it's the same. Okay, it's the same principle. Okay, now then I ask myself, what would be the treatment? So in my head, I remember the principle that as per IFRS 16, the lease liability must be discounted to present value, okay, of the lease payment. The lease payment has not yet been made, must be discounted to present value. Okay, then I ask this question, what constitutes my lease payment? Can you remember? There are 5 of them. Number 1 is what? Fixed payment. Then I ask a question, where's my fixed payment? It's going to tell me. It said lease payment are 10,000 per year. Can you see? They are 10,000 per year. That's it. That's my lease payment. Okay. Then I ask the question again. Do I have any variable payment here? We have read it. There's no variable payment. Do I have residual value guarantee? There is no residual value guarantee. Okay. Do I have a what's it called? Option to purchase the asset? At the end of the period. I did not have. Okay, so I move on. Okay, or do I have termination penalties? I did not have, so I move on. So it only gave me my fixed payment. Okay, so then I ask again, what is my what's it called? Interest rate implicit in the lease. So here it said the interest rate implicit in the lease is not readily determinable. Okay, if it's not readily determinable, what about incremental borrowing rate? It's going to tell me. So it said the incremental borrowing rate is 5%. So that means I'll use this 5% to discount this 10,000. Okay. Now, but before I do that, I need to also look at my lease terms. Okay. Can you remember we said lease term contain 3 things. Number 1 is what? Non-cancelable period. So when it said dynamic enter into a 2-year lease for a lorry, so the 2 years is the non-cancelable period. Then I ask myself, do I have option to extend the lease? And it's reasonably starting that is going to be exercised. It's going to tell me, okay, it said the contract contains an option to extend the lease for a further year. Dynamic believes that it is reasonably certain that it's going to be exercised. Can you see now? You are asking yourself question and you are throwing it back to the question in your front. That's how to attack questions, okay? Because you know the principle. You ask the questions based on the principle. So that means my non-cancelable period is 2 years, and option to what's it called now? Option to extend is also 1 year. Okay, that's why you have this 15,000 here. Then I'm ready to solve this question. Okay, so I'll now say my normal discount factor. Do you know my year 1 to year 3, my cash flows, my discount factor, which is 5%. I multiply it by those cash flows that I get my present value. It's as simple as that. So let me show you so that you can relate with that. Okay, can you see it now? Okay, so because it said the payment is made at the end of the year and we enter the contract at the beginning of the year. So I simply write 31st December 20x1, okay, and 20x2, 20x3. So this is the original period, which is 10,000 and 10,000, and the option to extend because we were told that it's going to be exercised. Okay, so I use my discount factor of 5%. Can you see? So when I multiply the discount factor for the first year, I'll have 9,524. For the second year, 9,070. For the what's it called, third year, 12,958. So if it is 30 years, that's exactly the way you're going to do it, okay? It is a land lease, like the question that was thrown there. That's exactly what you're going to do. So this figure, okay, is the present value of the lease payment that has not yet been paid. That's it. Then I move on to my right of use assets. okay? And we said the right of use asset will be initially measured at cost. And what constitutes my right of use asset? Can you remember? The initial amount of the lease liability, which is this 31552. Can you see? That's it. Okay. Then number 2, any payment made at or before the commencement of the lease. We were not told that any payment was made, so I ignore. Then I ask again, is there any direct cost? Okay, initial direct cost. The question will tell me, it said here that to obtain the lease, Dynamic incurs initial direct cost of 3,000. Can you see? The question is going to tell me. So that is why you need to bother on knowing the principles, okay? On knowing the principle, you can attack any question. Just use that principle on those questions. That's why if you notice my style of lecturing or teaching, okay, I take a lot of time in explaining the principle so that when we get to the question, I can assure you within 5 to 10 minutes, no matter how big that question is, we will dismantle it, okay, because we know the principle. So when you ask those questions, so you're not struggling, okay? So it said, I ask, where's in the initial direct cost? It tells me, it says it's 3,000. Then I ask the last question, is there any what's it called, cost of dismantling or removing the asset? He did not tell me. Then I move on, okay? But it says something here. He said the lessor immediately reimbursed, okay? But I needed to recognize the 3,000 because I've paid it. I've now recognized the 1,000 as income because it was reimbursed back to me, okay? So that's it. So you now put the initial measurement of the lease liability here, the initial direct cost, and the reimbursement that was done. So the value for my right of use asset is 33552. Okay. So this is your accounting entry. So obviously you are going to debit right of use asset, okay, with that amount. Okay, can you remember? And your lease liability. Okay. So with that 3,000 again, you debit right of use asset by 3,000 and credit cash because cash gone out. Okay. But it gave me back 1,000. That's why you are recognizing cash again, and you are also reducing the value of right of use asset. It's as simple as that. That's what the examiner wanted to do. Okay, that's what the examiner wanted to do. Now, because I'm teaching, that's why I first took you that part. But obviously, you may not expect the examiner to limit its question to that. So let's now find out what happens on initial measurement, and exactly is what you expect from the examiner. Right from that, what happens on subsequent measurement? Right from the initial measurement, normally when the examiner is going to take you on IFRS 16, he's going to ask you on subsequent measurement, but you cannot do subsequent measurement without doing initial measurement. That's why I have to take you through that, okay? And I don't want to complicate issues. So that's why I needed to take you step by step. So I believe you are enjoying that, right? Okay, so let's look at subsequent measurement. So the simple analogy is this. You know, the carrying amount of the lease liability will be increased by interest charges. Do you agree with that? The carrying amount of my lease liability, you know, I have interest that I needed to pay, okay, every month. So that means, or every year, as the case may be, that means the carrying amount of my lease liability will be increased by interest charge. So what do? I debit my finance cost and I credit my lease liability, okay, because it's going to be increased by that amount, okay. But when I make payment, that means the kind amount of my lease liability will be reduced by cash payment. So when I make repayment, the kind amount of lease liability will go down. So what do? I debit lease liability and I credit cash. That's the meaning. Now, what now happens to my right of user asset? I need to depreciate it, okay? So you don't need to really bother yourself around here. Just depreciate using the, the lease term. That's what the examiner will take you on, okay? You depreciate using the lease term. Okay, but here he's saying that if ownership of the asset will transfer to the lessee at the end of the lease term, depreciation will be done over the economic useful life. Okay, so that means if ownership will transfer to me, okay, it's going to that means when I'm depreciating, I will use the economic life. I will not use the lease term. Otherwise, if it will not, that means I will use the lease term. That's the meaning. Okay, but if the examiner is silent, whether or not the ownership will transfer, so just use the lease term. But once the examiner has said ownership will transfer, then use the remaining useful life to depreciate the right of use asset. Okay, so let's now look at this question. The same question that we have just done is what we are looking at again. It said from the previous exercise, the answer required, explain the subsequent treatment, okay, of dynamics lease in the year as at the end 31 December 20X1. Okay, the same question. So how will the subsequent recognition will look like? So this is what we expect from the examiner. So once you have this kind of question from the examiner, you are going to start from where we started from, okay, by discounting the lease payment that has not yet been made to the present value, okay, and you go ahead and also recognize your right of use asset, okay, you go ahead and recognize your right of use asset, okay. So what do you do here? Okay, sorry, what do you do here? Okay, sorry, hold on. Let me try and, sorry. Now, okay, now, sorry. Now, so what do we now do here? You now do what we call a lease liability table, okay? So let me show you that. You do what we call a lease liability table, okay? This is what you do. And this is what I was saying the other time. You can formalize this in your Excel and you put on your lease payment there, even if it's 100 years. Just put it on the lease. You know, so you're not going to create 5 columns, okay? The year ended, okay? But you know, the examiner wanted us to calculate up to December 20X1. That's why you're not seeing all the 3 years, okay? You calculate the year ended, which is this is the year ended. Can you see? You do the opening balance, then you do the interest payment that you're making, and the closing balance. That's it. That's the column you are going to create. So you need to learn this, okay? You need to learn this. Now, so what do I do here? So when you come to December 20X1, you know the present value of the lease liability that has not yet been paid will be your opening balance, you know, because it's going to be made at the beginning, at the end of the year, okay? It's in the question already. So I bring on this figure so everybody knows how we got this figure initially. That's the present value of the lease liability that has not yet been made. So I bring it as my old opening balance. Can you see now? That's why I said this is what the examiner will actually ask you, but you needed to start from there, okay? Now I will charge 5% because we said the carrying amount of the lease liability will be increased by finance charge. Can you see that? Or by the interest rate, okay? So it's going to be increased. So when I charge 5% of 35512 or 31552, I'm going to get 1578 approximately, okay? Now, when I make payment, the carrying amount of my, what's it called? Lease liability will be reduced by cash payment, okay? So that's why you are seeing this in jacket, because the cash payment will reduce my liability, and 10,000 is going to be made every year, okay? So that's why you are seeing this 10,000. Now be with me here. We now had 31552 plus 1578, and you remove 10,000, you're going to get this figure 23,130, okay? You get 23,130. So that's my closing balance at the end of year 1, okay? In my year 2, the closing balance in my year 1 becomes my opening balance in my year 2. Can you see? Even if it is land for 30 years, that's exactly what you're going to do, okay? So the closing balance in my year 1 becomes the closing opening balance in my year 2, okay? The same amount, I will charge 5%, okay? I'll charge 5% on that amount. So when I charge 5% on 23,130, it's going to give me 1157. So when I add 1157 together, I will add it to 2310, and I remove 10,000. It's going to give me 14287. Okay, it will give me 14287. Okay, so that is it. Okay, so once you're able to do that, then you are fine. So how do I now interpret this? Now, what does this supposed to mean? Now be with me here. Okay, be with me here. You know, this is my closing liability in year 1. Okay, my closing balance liability at the end of year 2 or the beginning of year 3 is 14,278. So what does that supposed to mean? That means when I'm preparing my account in year 1, my non-current liability, you know, normally they will say non-current liability are those liabilities that will be due for more than 1 year. So that means my non-current liability will be 14,287. So what will now be my current liability? My current liability will simply be 23,130 minus 14,278. That will be my current liability. It's very simple. Okay, so that is what was done here. Can you see? So this liability, the finance charge in year one. Okay, the finance charge in year one. What do? You debit lease liability. Debit finance cost and credit lease liability. So that's what was done here. Okay, and the cash will reduce the carrying amount. So you debit liability and credit cash. Okay, so this is what I just explained. The liability has a carrying amount of 23130 at the reporting period. Of this, 14,287 will be non-current liability. That's it. And the difference between the two, which is 8843, will now be the current liability. So what do I do to my right of use asset? Because I'm not done, I will now depreciate it. You know that figure that we got earlier on, 33,552, if you remember, and the lease term is 3 years. Okay, you depreciate by dividing by 3. So the figure you get is your depreciation. So what do? Debit POL account and credit right of use asset with that amount. So my carrying amount will now be 22,380. It's very simple. That is leases for you. As God we made it, we are done with lease. Okay, so the next thing we need to look out for is reassessing lease liability. You know, I mentioned something earlier on. You know, when we were talking about what constitutes what's it called, constitutes the lease payment. We said variable payment that depends on an index rate. Okay, so that's what we want to see here. And once you understood this concept, it will be easier for me to explain COVID-19 impact on IFRS 16, the new amendment that was done. Okay, so I want to believe you understood what we just did. It's very simple, it's very straightforward. Lease is very straightforward. Okay, if you understand it, let me know, please. I need feedback from you if you understand before I do this. Just tell me you are understanding. It's very straightforward. I've tried to, break it down for you. Okay, now, so let's look at reassessing lease liability. Okay, so if there are changes, if changes occur, okay, to lease payment, okay, then the lease liability must be recalculated. So, for example, changes occur because I normally pay 10,000 and now it has to be 20,000, and don't forget, it has to be part of the negotiation or part of the contract from the inception. It's not changes that I'm bringing on maybe because of COVID-19. Okay, so that's what you need to understand. COVID-19 was never part of the contract. That's why there was an amendment. Okay, so here, if there is a change, okay, to the lease payment, that means the lease liability we have to be recalculated. That means the current amount we have to be adjusted. Okay, so IFRS 16 now says that lease liability should be recalculated using the revised discount rate if the lease time changes and the entity has assessment of the option to purchase the underlying asset also change. Okay, or even if it's dependent on a variable lease payment. So let's look at this example to make you to understand better. I said on 1st January 2021, Kingfisher enters into a 4-year lease contract or lease 4-year lease of property with annual lease payment of 1 million payable at the beginning of the year. You know, initially we looked at the end of the year. So what happens at the beginning of the year? According to the contract, lease payment will increase. Can you see? It will increase. It's part of the contract. That's what I want to emphasize. Okay, if I take you on COVID-19, right? Now it said it will increase every year on the basis of the increase in consumer price index for the preceding 12 months. Okay, so the consumer price index at the commencement was 125. Okay, can you see that? And the interest rate implicit in the lease is not readily determinable, but the incremental borrowing rate is a 5%. Okay. Now say at the beginning of the second year, the consumer the lease of the lease, the consumer price index is 140. It has changed. Can you see? It has changed. That means we need to recalculate the kind amount of the lease liability. That's the meaning. It has changed from 125 to 140. Okay, now say required discuss how the lease will be accounted for during the first year of the contract and on the day of the or the second year of the contract. Okay, that's fantastic. So what do I do here? So when I see this kind of question, what do I do? Okay, I ask myself, where is the fixed payment? Because I needed to recognize a right of use asset and a lease liability. The examiner told me it's 1 million. Can you see? It's 1 million naira, and it was paid at the beginning. Okay, it was paid at the beginning. of the year. Okay, so what do I do immediately? I credit my cash immediately because it has gone out, and I debit my what's it called, right of use assets. As simple as that. But for my lease liability, what do? I have to discount, the future payment that has not yet been made to the present value. Okay, because I have paid for year one. That means, so that's why you need to understand. I've already paid for year one, but I've not paid for year two. I've not paid for year two, but I needed to get the figure right from now. So I need to discount to present value. So I'll simply do my normal discounting factor table. Okay, can you remember? That's what I will do. Okay, so let me show you that. Okay, let me show you that. So this is what you do here. Can you see the 1 million naira? Can you see debit right of use asset immediately and credit cash? Okay, but from the beginning of year two. So what do? I need to calculate the present value of the lease payment that has not yet been made. Now, be with me here. Don't get confused. The question said, what will be the accounting treatment during the first year of the contract? That's what we are doing. And what will now happen in the first day of the second year of the contract? That's when I will now recalculate the current amount of the lease liability. But the question is, what is even my current amount now? So when I do the calculation here, can you see that's the 1 million. I discount by 5 million all together. I have 2.72 million. Okay. So what do? I debit my right of use asset plus that 1 million. Okay. Then credit lease liability. Okay. So that's what you have here, and you divide by 4 because it's 4-year period to get your depreciation charges. Okay. I will now go ahead and do my lease liability table on my subsequent measurement. Can you remember? So that's what's it called, for my year ended. Can you remember, of the first year? So that 2.72 that we just see there. Okay, I'm sure you can do this, right? And the interest payment. So if you notice, there is no cash payment here because the cash is already paid at the beginning of the year. Okay, so that's why you're not seeing cash payment here. So the only thing we are interested in is the carrying amount of the lease liability at the end of the period. So when you had 0.14 to 2.72 together, you're going to have 2.86. So that's what you have here. That's what is being done there. Okay. So the what's it called? The interest charge of 0.14. We now debit the finance cost and credit lease liability. Okay. So the liability has a current amount of 2.86. That's what you have there, at the end of year one. Now, I now come to year two, and I was told that the consumer price index has changed from 125 to 140. So what do? The 1 million I paid, I just have to recalculate it to get the new amount. That's the meaning. Okay. So what do? I will simply say new figure over the base year, or I say current year over base year. Base year is the previous year. Okay. The current year consumer price index over previous year, and the current year is 140. Okay, divided by the previous year base year, which is 125, multiplied by the 1 million of the lease contract. So if you do that, you're going to have 1.12 million. Okay, so you have to discount again to present value. Now, because I'm doing it at the beginning of year two, you don't need to discount that because that's 1.2 already. I just got the figure. Okay, I will now discount from the second year, which is the third year now, because you have done year one already. Okay, so it will now be -1 here and -2 here. Okay, that's 1 plus r raised to power minus n. That's the figure to discount. But if you want to use this figure, this formula as well, is also the same thing. So when you do that, you have 3.21. Okay, you have 3.21, and we have 2.86 as at the last year end. Okay, you now remove it. Okay, that means the difference between the two is 0.35. Okay, and we have to that means we have recalculated the current amount of the lease liability. So what do? You debit it to the right of use asset and credit right of use asset with that amount. Okay, it's very straightforward. And that's the end of the question. Okay, so let's now go to, I just have to take you that so that this will not be a problem. So let's now go to lease under IFRS 16 during COVID-19. Okay, so everybody has been doing leases, contract, everybody was happy. All of a sudden, there was COVID-19 pandemic. Okay, and because of the coronavirus and all of that. So what happens? So let me just explain what I have written here. So what happened is this. Let me give you FCA as an example. FCA has a facility that was rented, or let's say that was leased. Let me use the word lease now, okay? Let's say it's leased for 5 years, for example. Okay, so we in 2019 the lease contract started, and it's going to be for 5 years. Okay, in 2020, maybe at December 2019, we paid some amount of money because the payment is going to be made at the end of each year. So in 2020, COVID-19 happened. All of a sudden, we cannot hold classes, physical classes again, okay? And the rent is, or the lease payment is there, okay? So because we cannot hold classes again, what has happened? Cash sales, or is this sales now? Or okay, money received from sales revenue has significantly declined, and because revenue has declined, what happens to liquidity position is also badly impacted. Okay, and the what's it called? The school's expenses are fixed. Okay, you need to pay the rent or lease, some other, maybe the teachers and all of that, you need to pay them. Okay, so what now happens is this: if you approach the landlord, he can decide to give us what we call rent concessions in two forms. For example, he can delay our rent for the second year or quarter, depending on the way we are paying, or he can also decrease the amount we are paying. So for example, if you are paying 40,000 every year, for example, you can say, okay, I'm giving you some discount, okay, and you can start paying, let's say, I'm giving you discount of 28,000 or 12,000, as the case may be. That's the two ways it can be done, okay? So I'm just trying to use that as a background. Since it has been done that way, and don't forget, after the beginning of 2019, we would have calculated our list liability table, done everything correctly, and we move on, okay? Now, how do you now account for rent concessions under IFRS 16? It's very straightforward. It said rent concessions are called lease modification in all cases, in most cases. So according to lease, a lease modification is a change in either scope or payment for the lease that was not part of the original condition. Can you see that? That's what we call lease modification. Okay, so lease, what we just did now, the question we just solved is not lease modification because the variable payment was part of the contract at the beginning of the contract. Okay, but for COVID-19 pandemic, it's never part of the contract. So once the scope or the payment is changing, then it becomes a lease modification. Okay, so it now requires recalculation and adjustment of the lease liability. Normally, modification will require an adjustment of the lease liability, but because there are so many headaches around that, you can imagine a company that has so many lease contracts before they go back and start recalculating. So that's why there is now a new amendment on IFRS 16 to reflect COVID-19 pandemic. So how can entities go about it? It said in May 2020, the ISB issued an amendment of IFRS 16 to tackle exactly the rent concessions provided by to the lessees as a response to COVID-19 pandemic. So the title of the new amendment was called COVID-19 related rent concession. So the main message in this amendment is that you do not have to account for rent concession as a lease modification. So that's what the ISB was saying. So don't let us complicate issues. So you don't need to take it as lease modification because it will require you to recalculate the entire, lease payment. Okay, and before you can do that, 3 conditions must be met. That means the revised consideration must either be the same or less than the consideration before the change, and the discount on rentals must not go beyond June 30, 2021. So what it means is this, like the SA example I gave you the other time. We started in 2019 January, okay, and the landlord now gave us concession this year. So what it means is this: the concession must not go beyond 2021. I need to account for that. Okay, once it goes beyond 2021, then I cannot do it this way. That's the meaning. That means I have to now take it as a lease modification. Okay, so that's it. So therefore, if your lease term ends in December 2021 and the lessor gives you a discount on all payments on 2021, then that means you cannot apply expedient on all the lease. You have to recalculate everything. That's the meaning. Okay, so no other significant change in terms of the conditions of the lease. Okay, so what does it really mean? So what does it really mean? But I don't want to take it as a lease modification. So what does it mean? It simply means that if the lessor decreased or forgave the lease payment, then you simply treat them as a variable lease payment not included in the measurement of the lease liability. So instead of me to recalculate my lease liability, I will just treat it as a variable lease payment that is not included in the lease liability. It simply means I will recognize it straight into my profit or loss account. That's the meaning. That's the meaning. It's very straightforward. Okay. So what I've just explained is what is demonstrated here. Okay. Is what is demonstrated in that figure, in that diagram. Okay. Now, so let me now show you how to do that. Now, so let's say ABC rented an office in January 2019 for 3 years. Yearly payment is 40,000. ABC annual incremental borrowing rate is 3%. Payments are made at the end of the year. So if you see this question, everybody can do this, Abby. Everybody can do this. So what do? You do discount factor, Abby, by saying my dates, Abby, the cash flow of 40,000. Then you do the 3%. What's it called? Discount rate, and you get your present value. Okay. So when you add everything together, I have 113,145. Everybody can do this. Then I debit my right of use asset and credit my what? Lease liability. Okay. So that's what you have around that area. Okay. So everybody can do that, right? Now, I will now do my lease liability table for subsequent recognition. Can you remember? Okay. For my 2019, 2020, and 2021. So I have my opening balance. Can you remember? I'm just trying to remind you what we just did. I bring on that figure. I calculate the interest on it. Okay. Okay. That's 3% of this lease liability. So what was the payment that was made? It's 40,000. This is a new column I'm introducing so that I can explain further. That's reduction in lease liability. You know, my lease liability is 40,000 every year, and the interest payment is or interest expense is what's it called? 3,394 for year one. So if I remove 3,394 from 40,000, obviously I'm going to get this. Okay, 36,606. Okay, so that's my reduction in lease liability. So if I had 3,394 plus 11315 and I remove 40,000, obviously I will have 76,539. Okay, that's what we have been doing, Abby. Okay, so this becomes my opening figure here. Can you see? Okay, I do the same approach. Okay, I have 3,835 here. Okay, it becomes my opening balance here as well. I do this until I have 0 because it will end at the end of year 1. So if you had 1165 plus 38835 together and you remove 40, obviously it's going to give you this 0. Okay, so it's because the examiner limited us earlier. That's why we didn't do everything. Okay, it limited us to the year we needed to calculate to. Okay, now this is what I would have done without COVID because I didn't know there was COVID. Okay, I have a 3-year lease contract. This is what I would have done in my account. Now, COVID-19 rent concession impact on lease liability. So COVID-19 now came. Everything went smoothly, and then pandemic hit, and ABC lost a lot of revenue. So ABC's lessor provided the discount for the next 2 payments, that is second and third year, amounting to how much? 28,000 per payment. So my landlord or my whatever now gave me concession to say, okay, I'm giving you a discount of for your next 2 payments. Instead of paying 20,000, what's it called, 40,000, I'm giving you a discount, of 28,000. So I now decide to not to take it as a lease modification. Okay, so because the IFRS are permitted it. Okay, so therefore the lease payment I'm to pay is what? 12,000 for the second year. Okay, because that was 2020. But the third year, yeah, it would have gone beyond June 2021. So what happens? I will just leave it the way it is for my year 3. But I needed to look at my year 2. So what do? I will simply debit interest expense for that year 2 into my profit or loss. Can you remember that interest expense? I will do it normally. Okay, now that's what I was saying here. See the yellow line? That's why I put that yellow line there. Now, I will now debit reduction in my lease liability. I'm pretty sure you know that. It's there. Okay. Now, so what happened? I will now credit cash. Okay. Because I'm paying 12,000 naira now instead of 40,000. So I'll credit cash with 12,000. That's the 40,000 less the discount of 28,000. I will now credit profit or loss with the 28,000 rent concession that was given. So the payment for the third year will be recognized accordingly. It's as simple as that. So that's the COVID effect. So the ISB do not really want a lot of complications. Okay, so that's why they just say, just take it straight, treat it as variable payment and take it straight to your profit or loss account. It's very simple, right? Okay, so that is it. And that's the end of IFRS 16. So you have some questions that you can practice on your own. In case you're having difficulties, let me know. Okay, let me know. Okay, so let's move to the standard. Okay, so sorry, IS 37, provisions, contingent liabilities, and contingent assets. Okay, COVID-19 is also spotlighting this standard. Okay, and this standard is very key. Even if there is no COVID, the very key standard between in both financial reporting, corporate reporting, and even in practice. Okay, so let me quickly explain everything in the next 10 minutes. Then we'll look at questions. Okay, now we said IS 37 deals with provisions, contingent liabilities and contingent assets. Now, normally, if you go to a shop and you buy on credit, that means you did not pay. That is a liability. You are certain, okay? So you can go ahead and recognize a liability, okay? But when you are not really sure, where are some transactions will eventually result into liability, they are thinking whether I can provide for them, okay? That's what we call provisions, okay? So I'll first deal with provisions. I'll look at contingent liabilities and assets. Then I'll now take you on specific application when it comes to provisioning. So the whole idea around IS 37 is that entities can decide to use provisions or IS 37 as as a way of window dressing the account. Okay, so what is that supposed to mean? If you remember in the previous section, I made mention of big bat accounting. Okay, so what does that mean? In the year that a company is making enough profit, I can decide to create provision to reduce my reported profit for that period. And the subsequent years I'm making losses, I can now decide to start releasing those provisions. So that's what companies normally do. Okay, so that's the essence. That's what IS 37 is trying to address. So how is provision defined? A provision is a liability of uncertain timing or amount. So what does that mean? That means there's a liability we are seeing, but we are not sure of when we are going to pay, okay? So that is the uncertainty around the timing or amount. How much will it be? We are not sure. So we needed to make provision, okay? And provision requires judgment. We said IFRS itself also is a principle-based accounting system that requires judgment, assumptions, and estimation, right? Okay, so when I'm trying to make provision, I'm trying to make a lot of estimates around that, okay, which requires significant judgment. So if IS 37 is not really applied properly, it can lead to window dressing or sometimes creative accounting, okay? And but we needed to actually apply properly. So at what point can I make provision? So that's what we need to learn. So we have said provision is a liability of uncertain timing or amount, and liability is a present obligation arising from past events that will lead to an outflow of resources embodying economic benefits, okay? So that's a liability. But in terms of provisioning, we are not really, it's also a liability actually, but we are not sure of the timing or amount. So in order to prevent entities, from using IS 37 or provisions, to manipulate reported accounting or profit, there are three conditions that must be met before you can recognize provision. So whether you're writing financial reporting or corporate reporting, you have to know those three conditions, okay? Because that's how the examiner is going to play around, when giving you scenario-based questions or even calculation-based questions when it comes to provision. So when you say question on provisions, you have to check those three conditions. Okay, so you have to be with me here as I explain those conditions, because they just give you, a lot of scenario-based questions, and you're wondering whether provision can be provided. Okay, number one, there must be present obligation, legal or constructive, as a result of past events, which is also known as obligating event. That's one condition that must be met. Number two, an outflow of resources will be required to settle the obligation. And number three, the amount of the obligation can be measured reliably. You have to put them in your head, because the examiner can ask you to explain that area. So let me come back to them again. So I'm going to spend a little time explaining them. Once you understand that, then we are ready to solve questions. It's as simple as that, okay? So that's recognition criteria. I told you the last time that anytime you look at standard, think of four things. Can you remember? Technical definition, recognition criteria, measurement criteria, and disclosure requirements. Okay, so as per your exams, you bother much on recognition criteria and measurement criteria. Sometimes you can also bother around technical definition, but don't really bother about disclosure requirement. Nobody bothers you around that, except you are in practice. Okay, then you can easily look at those standards and look at the disclosure requirement. Okay, but for your exams, it's highly irrelevant. Okay, now, so this is recognition criteria. We said there are three of them. So let me quickly explain them. We said number one, there must be present obligation, okay? Legal or constructive. So what do we mean by legal? Legal simply means it arises as a result of contract, okay? It arises as a result of contract. So for example, you are selling, phones, okay? Or you are selling electronics, and I approach you that you should supply me some electronics, okay? So part of the contract was that if those electronics get faulty within the next 12 months, or maybe you gave me a warranty for 12 months, I can return them, and you're going to repair you're going to repair them for free. That's the legal contract, because it's already documented and we have signed. Okay, that's why they said there must be present obligation, legal, okay, or constructive. So what do you mean by constructive? Constructive simply means that we did not sign as a result of past pattern of practice of an entity, okay? For example, you normally repair phones that you have sold to people for free, even though it's not written anywhere that you will repair it for them for free. But anytime people brings back the phone they bought from you and you repair for them for free, maybe within 1 year that they have returned it, or you can exchange it for them, that means you have created a constructive obligation naturally, okay? So that's why the standard is saying there must be present obligation, legal or constructive, as a result of past event, okay? As a result of past event. That means obligating event. So you have to be with me here. So what do they mean by obligating event? Obligating event simply means it's a condition at which a company or an entity has no realistic alternative than to settle the obligation, okay? You don't have any realistic alternative. You just have to settle the obligation. That means you cannot run away from it, okay? That is what I mean by obligating event. But once you can run away from it, that means once you can avoid that obligation, that means obligating event has not been created. That's what you need to understand. So the first requirement or the first recognition criteria before you can create a provision is that there must be present obligation, legal or constructive, as a result of past events, which is obligating event. And number two, an outflow of resources will be required to settle the obligation. So when you say outflow of resources, what does it mean? It simply means you need to spend money. That means cash will go out for you to settle the obligation. And number three, the amount of obligation can be measured reliably. That's it, okay? That's it. So once you learn those 3 points very well and you can reproduce them in the exams or in any scenario-based question, then you are good to go. Now be with me here. Those 3 conditions must be met at the balance sheet date when you are preparing your account. If you meet 2 of them, you cannot recognize provision. If you meet 1 of them or 2.5, you cannot. You have to meet the 3, okay? So if you meet requirement 1 or condition 1 or recognition criteria 1, and you don't meet requirement 2, you cannot go ahead and recognize provision. Don't forget, the whole idea is to prevent entities, from from window dressing the account. Okay, so that's the whole idea. So the examiner can decide to give you any scenario. They have already recognized provisioning, and they give you a scenario, and you realize that they did not really meet the criteria. That means they need to reverse it. That's the meaning. Okay, so that's it. So that's what you need to learn. So on recognition now, measurements. How do you now measure provision? Oh, sorry, I'm not even showing you from the screen. I think I mentioned it the last time. I don't really like looking at the screen when I lecture. Okay, so sorry about that. Okay, so that I can really flow very well. Okay, so when it comes to measurements, okay, so after those criteria has been met, how much will I now, how much or what value will be my provision? Okay, because it's provision, it has to be an estimate. So the standard says for a single obligation, for example, court case, you are going to measure it, using the most likely amount payable. So what I-37 is saying is you have to measure provision. It requires that you measure provision at the best estimate of the expenditure required to settle the obligation, okay? At the reporting date, the best estimate, can you see? The best estimate of the expenditure required to settle the obligation at the reporting date. And the best estimate for a single transaction or obligation is the most likely amount payable. Okay, for a large population of transactions, that has to be an expected value. Okay, either of the two or both of them has to be discounted to present value, especially if the figure is material. Okay, so it's that's what you need to learn. Okay, so let's look at this question to do that. It said this question is very simple. It's just for you to solidify your understanding another area. I said Clean sells domestic appliances such as washing machine. On 31 December 2021, Clean decided to start selling washing machines with a warranty. And under the warranty, Clean will repair washing machine at no charge to customer if they break. Can you see? Under the warranty, that means they have created the legal obligation. So the entity estimates, based on past correspondence with customers, that 20% of the washing machine sold will require repair within the warranty period at an average cost of 50 naira per machine. Clean sold 200 machine on December 31, 2021. The time value of money should be ignored. That means they say you should not bother about discounting. Okay, calculate the warranty provisions required. So how will I know? Even if the examiner, here as well say calculate the warranty provision. So that means the condition has been met. Okay, well, let's say in part 1 of that question, the examiner is saying I should determine whether they can go ahead and create provision. How will I know? He said normally this is what they do. They sell domestic washing machine. Okay, so here they decide to sell washing machine with a warranty, and under the warranty, Clean will repair. Can you see? They have created a what's it called? A legal obligation. So from there, I needed to now calculate. Okay, so they have created a legal obligation. That means there is a present obligation, legal or constructive, as a result of past events, which is an obligating event. So that means I have no realistic alternative than to repair for them when they bring it back. Okay, and the number 2 condition is an outflow of resources required to settle the obligation. Okay, so when they bring it, I needed to spend money. Okay, he even told me, I said the repair within the warranty period will cost me 50 naira. Can you see? And the cost can be measured reliably. Okay, so that's it. So what do? I just ask myself, how many machines did they sell? They sold 200 machines. Okay, that's fantastic. At what rate? At 50 naira. I multiply it to get the total machine that was sold. So if I multiply 50 times 200, I get a particular figure. Abi, how many is going to be returned? Okay, that should be 10,000, right? How many will be returned? He said 20% will be returned. So 20% of that amount will become my provision. It's very simple, like I said. Okay, it's very simple. So that's what you do there. So 20% of that amount will give you 2,000. Okay, and that is really the provision you're going to do. So what do you do? Debit POL account and credit what's it called, provision within your current or non-current liability, as the case may be. Okay, now on subsequent measurement, what do you do? Just like we did in leases, you're going to debit finance cost and credit provision. Okay, because once you have incorporated the discount factor. But in that question, the examiner did not say, it did not really bother us about that. Okay, and you recognize, and now listen, now the whole idea around provision is this: you have to use it for what it was meant for. That's it. So if they did not return, you have to recognize. That means you write it back. That's it. Can you see now? I've already debited my profit or loss. My profit would have come back, would have come down. So if I didn't use that money, so what do? I write it back. Okay. So that's what they mean by derecognition. So I cannot use it for another thing. Okay. It has to be what it has actually, been created for. Okay. So let's now look at that's with provision. I'm still coming back to provision, but when we look at specific application, there are just 5 of them. Then, and I will now show you the impact of COVID-19, that is what is actually, spotlighting around here. Now, let's look at contingent liability. This one does not require calculation. It's just for you to understand. Contingent liability is a possible liability, unlike provision, that is a present obligation. Can you see? Or there's a liability of uncertain timing, okay? But here, it is a possible liability. We don't have obligation yet, but we are seeing it as a possible obligation. That's why they said it is a possible obligation arising from past events whose occurrence will be dependent on one or more uncertain future events. Okay, for example, in November 2019, a customer sued your company and they take you to law court, but you're not sure whether you will win the case or not, okay, or whether money, when you lose the case, that means you're going to pay for damages. That's the meaning. So because I'm not sure, it is a case of contingent liability. Okay, so that's what we call a contingent liability. It could also be tax dispute. Okay, it could also be what's it called, guarantee. Maybe you give somebody a guarantee. Okay, you give somebody a guarantee, for someone, you are standing in for somebody, but you're not sure whether the person will go there and steal money and you to now require to pay. So it is a possible liability or possible obligation. So as per IAS 37, contingent liability are never recognized in the financial statement. But once they are probable, or once it is it's probable, once it's remote, you might decide not to do anything about it. But once it's probable, then you can disclose it as a note to the financial statement. Okay, so that's what you have as contingent liability. Like I said, it's very straightforward. Now, okay, can you see examples there? Pending court cases, warranty provision, financial guarantee. Now, the court case is against you. Okay, once it's in your favor, you are the one that is now suing another company, then it becomes a contingent asset. Okay, it's the same. So a contingent asset is also a possible asset that arises from past events whose occurrence will be dependent on one or more uncertain future events which are not within the control of an entity. Okay, so if you have sued someone for damages, you're not sure that it will result into an inflow for you. So you take it as a contingent asset. Once it's remote, what do? You take it as a disclosure. Okay. Now, once you are sure that the money is coming, then it won't be a contingent asset again. It becomes a normal asset. So, but for a contingent asset, they are never recognized in the financial statement, but they can be disclosed as a note to the account. Okay, so that's what you need to learn. So let's now go to the 5 specific applications when it comes to COVID-19. But for my people that are writing corporate reporting, expect restructuring provision. Okay, because of COVID-19, there were a lot of restructuring in many organizations. I needed to lay those background so that when we get here, we will not struggle. For people writing financial reporting, the examiner may not really bother you around restructuring provisioning, but for you to have an idea is not out of place. Okay, so we need to learn it together. Now, so let's look at number 1. We have what we call future operating losses. Number 2, we have future repairs to assets. Number 3, we have onerous contract. Number 4, we have environmental provisioning. And number 5, we have restructuring provisioning. So let me see whether we can do that in the next couple of minutes so that we say bye-bye to IAS 30. What's it called? IAS 37. I quickly take you IAS 20 because of a lot of companies are getting COVID-19 relief and all of that. So how do you treat it in your account? You're going to see that under IAS 20, and we round everything up with IAS 8, impact of accounting policy. Okay, so let's see. Now, there's something we call future operating losses. For example, you can see that maybe one of your business venture, you have 3 lines of business, for example, and one of them you're anticipating that this business will start making losses in 2020, okay? Or maybe because of the impact of COVID-19, you are thinking, oh, by 2021, this business will start making losses, or by December this year, the business will start making losses, okay? So the issue now is this: can I make provision for future operating losses? Okay, can I make provision for future operating losses? Don't answer me yes or no. Don't answer the way you think, okay? We are going to look at the standard. We are going to look at the principle. You know, I've told you, anytime you see questions, go back to the principle. That's the operating manual, okay? It's like you just bought a new TV or a new gadget or whatever, and you don't know what to do. All you need to do is to open the manual and study it first so that you can operate it effectively. So whenever you see questions, don't say, oh, this is supposed to be. No. You can only do that if you are very experienced and you have knowledge of the standard, okay? Because sometimes you might also need to apply some judgment, okay? But if you don't really have that, then you have to look at the standard. What is the standard saying? So when I look at future operating losses, so the question is, can I create provision for a business venture that I'm thinking is going to start making losses because of the impact of COVID-19 pandemic? Then I ask myself that what is the standard saying? The standard is telling me that before I can create provision, 3 conditions must be met. There must be present obligation, legal or constructive, as a result of past events. That is obligating event. An obligating event simply means I have no realistic alternative than to settle the obligation. He also said it has to be present obligation arising from past event. Future operating losses is in the future, is not in the past. I'm looking at it in the future. So that's number 1. That condition was never met. Okay, that condition was not met. So that means I cannot recognize provision. Let me further explain. You know, we said as a result of past event, which is obligating event. And I told you the obligating event simply means a company has no realistic alternative than to settle the obligation. So for a business venture that I'm thinking is going to start making losses from 2021, I can avoid that obligation by selling off the business before that time. That's it. It's so simple. Just apply the principle. I don't even need to go to requirement 2 because 1 already is failed. I can sell off that business before that time. It relates to the future. That's it. Let me explain the second one, future repairs to assets. Before I come to onerous contracts, then I go to environmental provisioning and we look at restructuring and we say bye-bye to ISR 37. Okay, now future repairs to assets. Let me give you a very classical examples. Let's say you work in an airline company, okay, and you are the chief accountant, and you have what we call aircraft, okay? You have aircraft. You know, in the aircraft, you have other components that are depreciated separately from the aircraft itself. Abi, I'm sure you are aware of that. That's what we call componentization under IAS 16. You know, when you have an asset, and within that asset, you have other components that are depreciated separately from the aircraft itself, because a typical aircraft can use 50 years, 70 years, 100 years. Meanwhile, there are some components that you depreciate for 3 years, for 4 years, for 5 years. Okay, so that's it. Or in another example, every 6 months in your company, you must overhaul your AC, okay, your air condition. They must come and repair them, okay. They service them every 6 months. It has been in your policy. So the issue now is this: when I'm preparing my account, I'm definitely sure that in the next 1 year or in the next 6 months, I'm going to repair my AC. Or in the next 6 months, I'm going to replace some certain components in my aircraft. So the issue now is this: can I make provision for future repairs to assets, because I am sure that I'm going to spend that money when the time comes? Okay, so how do I know? I ask myself again, what is the principle? The principle says there must be present obligation, legal or constructive, as a result of past events, obligating events. Now, you may argue that there's a past event because I've already purchased those assets, okay? But the question is this: number 1, those repairs relate to the future, okay? They did not arise as a result of past events. It's only the purchases that arise as a result of past events. Then number 2, we said there must be what we call obligating event. An obligating event simply means is a condition that give an entity no realistic alternative than to settle the obligation. I am not under obligation to repair those assets because before the next 6 months, I might decide to sell the asset. That's it. I might decide to sell the asset. I think I was reading in the news recently that Medview Airline in Nigeria want to sell about 2 of their aircraft because of the impact of COVID-19. So can you see? So if they have, future repairs to that aircraft, they cannot create provision because they can sell the aircraft before those repairs are done. That's it. That's very simple. So that's what you need to understand, okay? But, maybe in practice, some accountants, they don't even really know the right treatment. That's why they keep having issues with external auditors, especially if those external auditors are very sound, okay? When they see provisions, then they want to find out whether those conditions are met at the reporting date, okay? So let's look at the third one, which is onerous contract. What is onerous contract? This can also be, as a result of the impact of COVID-19 pandemic. Can you see? Those accounting standards were carefully selected, okay? Now, onerous contract are those contracts in which the unavoidable cost of fulfilling the contract will exceed the economic benefit from the contract. And COVID-19 is one of the factors. For example, I have a lease, like we said earlier on. I rented a warehouse, okay, under lease. And all of a sudden, because of COVID-19, I cannot bring in my goods again from, I cannot import goods again to come and, store them in my warehouse for sale, okay? So I'm already running at loss. Meanwhile, the payment, the unavoidable cost to fulfilling that contract, that's the lease payment, okay, is running. So what it means is, once my unavoidable cost of meeting that contract will now exceed the economic benefit, okay, that is what we call onerous contract. So the issue now is this: can I make provision for onerous contract? Yes. The standard says you can make provision for onerous contract. But if you are doing that, you have to measure it at the lower of the cost of fulfilling the contract and the cost of terminating the contract. It's very simple. Okay, this is what I just said. Let me try to align that for you. You are going to measure it at the lower of cost of fulfilling the contract and the cost of terminating the contract. So you have to look at, okay, if I continue the contract, how much will I spend? If I decide to terminate, normally termination penalties would have been in the contract, okay? How much will I spend? So the lower of the two, you can decide to create a provision. So that is onerous contract for you, okay? So I've explained future repairs to assets. So now let's look at this question very quickly. He said, Dandy Boy is a company that owns several shops, which has a year ended 31 December 2021. One of the shops is loss making, and at December 31 2021, Dan Boy forecast that this shop will make a loss of 50,000 in the year ended 31 December 2022. On 31 December 2021, Dan Boy closed down a different shop, okay? At that date, there were still 3 years left to run the shop lease. Lease renter have 100,000 per annum. The landlord will allow Dan Boy to cancel the lease if it pays a one-off fee of 200,000. Required, discuss the accounting treatment of the above transaction in the financial statement for the year ended 31 December 2021. Now, okay, so when I see this question, what comes to my mind? The examiner said discuss the accounting treatment. So I don't know what the examiner is asking me here. But what he said was, Dan Boy owns several shops, okay, as at this date, okay, which are that's the accounting period. And I said one of the shops is loss making. So when I see this statement, I remember IS 37, future operating losses. Can you remember? One of them is loss making. So as at December 31, Dan Boy forecast that the shop will make a loss, of 50,000 in the year ended December 2022. Can you see? So the examiner can coin that question that because of COVID-19 pandemic is forecasting that it's going to make a loss of 50,000. So what do? Should you go ahead and make provision? Obviously no, because it relates to the future and the business can even be sold before that time. That's what you tell the examiner. He now said, I've answered that question. That's it. for that first part. It now said on 31 December 2021, Dan Boy closed down a different shop. Can you see? A different shop. It now said at that date, there were still 3 years left to run the shop lease. Can you see? Now, the lease renter are 300,000 per annum. Can you see? 100,000 per annum. And the landlord will allow to cancel the lease if it pays a one-off of 200,000. Okay, so this is not IFRS 16. Okay, this is not IFRS. So when you see lease here, it doesn't mean it's automatically, because if you look at it very well, they have given us two things. They said they gave us the lease rental because it's closing down another shop, right, because of the loss making as well. So this is a type of onerous contract. Okay, onerous contract is when the unavoidable cost of fulfilling a contract will exceed its economic benefit. So here I can create provision. I have to measure it at the lower of the cost of fulfilling the contract and the cost of terminating the contract. So what will be the cost of fulfilling the contract? I said lease rental are 100,000 per annum. So and how many year was left? It's 3 years. So that's 300,000. And if I want to terminate it, it will allow me to pay 200,000. So which one is the lower? 200,000 is the lower. So I can decide to recognize 200,000 as a provision. So simple like that. Okay, we have the answers there. You can go through them. Okay, let's quickly look at exercise 3. It said an entity has a reporting date of 31 December 2007 and intends to repair an item of plant next year. Can you see? It intends to repair an item of plant next year. The cost has been reliably estimated. Can you see? They met the third condition at 10,000. The repair made in the following accounting period at the cost of 12,000. What provision, if any, should be recognized in the financial statement? They cannot make any provision. It's not possible. Why? Because it's the future repairs to assets, and we can even avoid that obligation by selling off the assets before that time. It's very simple. Okay, let's look at exercise 4 again to further solidify our understanding. It said, under new legislation, an entity is required to fit a smoke filter to its factory by December 2007. At the reporting date of June 30, 2007, the entity has not filtered the smoke filters required. Should a provision be made at the reporting date for the estimated cost of fitting the filters? Now, be with me here. It said under new legislation, an entity is required, can you see, to fill a fit smoother. It's like your company, the Lagos state government, for example, if your company is located in Lagos, is asking you that you must, there's a requirement that everybody must fit, what's it called, a screening machine for COVID-19. I'm just giving it as an example. I'm trying to relate it back to this question, okay? So my report, it said, let's assume my reporting date is June, okay? June 2020, for example, okay? And it said by December 2020, everybody must fit a particular machine that screen people that comes into your facility. So when I'm preparing my account, it's required by the law, okay? That's what this question is saying. So when I'm preparing my account in June 2007 or 2020, the question is, can I make provision? Okay, so what's the answer? You should know the answer. I go back to the standard. Okay, it said, the standard says there must be present obligation, legal or constructive, as a result of past events, which is obligating event. There is no obligating event here. Obligating event means it gives me no realistic alternative than to settle the obligation. But I don't have obligating event here. Do you know why? I can decide to go out of business before December. So I cannot, okay? I cannot make provision. Can you see now? So the fact that it was required by law, you need to check properly. It can only be, that can only be an obligation if that law is retrospective. And that's the next point we want to check, which is environmental provision. Okay, when you come to environmental provision, you know, environment simply means the environment in which an entity operates. And if you look, if you observe very well, there are some companies that they make damage to the environment, like the oil companies, the paint companies, the chemical companies, even some pharmaceutical companies. Because of the chemicals and all of that, they spoil the environment. Okay, so there could be they might decide to make provisions, in doing what we call cleanup or restoring some industrial sites. Okay, so the issue now is this: can I make provision when it comes to environment damage that I've caused? Yes, you might decide to make provisioning, but before you can do that, it has to is either you have created a constructive obligation, or there is a legal requirement that is asking you to repair environmental damage. So you have to watch the question very well. If it's required by the law and it's going to be retrospective, so you can only make provision for damage that has already been caused, because it has to be as a result of past event. Okay, it has to be as a result of past events. So if an entity has created a constructive obligation to repair environmental damage, constructive means that means they have been doing it in the past, even without anybody telling them. Okay, so or they have publicized it on their website or in their policy, so they can decide to create a provision. Okay, so we have a question here, so let's quickly deal with this question to demonstrate that. Then we go to restructuring. Okay, now I said an entity has a policy of only carrying out a work to rectify damage caused by the environment if it's required by the law to do so. Okay, for several years, the entity has been operating an overseas oil rig which causes environmental damage. The country in which the oil rig is located has not had legislation in place that requires this damage to be rectified. A new government has recently been elected in the country, and at the reporting date, it's virtually certain that the legislation will be enacted and that will require damage rectification be enacted that will require damage rectification. Okay, the legislation will have a retrospective effect. Okay, so in the requirement said, for each of the situation, explain whether a provision can be recognized. Yeah, so for this one, it said normally they can make rectify environmental damage if it's required by the law. So they have been making damage all this while, to the environment, and they didn't make any rectification. So there's a new law that just came. Okay, that now said that they have, that at the reporting date, it's virtually certain that a new what's it called provision or legislation will be enacted that will require damage rectification. And here he said the legislation will have retrospective effect. I made mention earlier that entity can only create provision for damage already done. They cannot create provision for future damage that will be done. Okay, so since they have made some damage in the past, and this legislation will also have retrospective effect, they can go ahead and create provision. Okay, so in the part B of that question, it said, under a new license granted by local government, an entity has constructed a rock crushing plant to process material mined from the surrounding area. Mining activities have already started. Under the terms of the license, the entity must remove the rock crushing plant when mining activities have completed, and must landscape the mine area so as to create national park. Can you see? Now, this entity was granted a license, okay? And under the terms of the license, they must remove the rock, rock crushing plant. That means in the future, they have to remove it, but it's under the term of the contract. So the issue now is, can I create provision for the damage or the removal cost of dismantling, the rock crushing plant at the end of the license? Yes, I can. Why? Because it has created, I cannot avoid it. Okay, it's a present obligation arising from legal obligation or constructive obligation. So because it's part of the license agreement, then I need to estimate the future amount and discount to present value. Okay, so that's it. So you can see those answers there. So let's now go to restructuring. I'll simply explain restructuring, then we look at one question, then we move away. Everybody, you understand what restructuring is. Maybe in your organization, you will say, oh, the company is restructuring. So sometimes restructuring can involve downsizing, or trying to cut some line of business, or or it could also be an expansion. But in most cases, it's all about downsizing, creating redundancy. Okay, so because of COVID-19 pandemic, a lot of companies has gone into restructuring. So the issue now is, when a company has gone into restructuring, can I make provisions? Okay, now the standard is saying yes, you can make provision, but when some certain conditions has been met. Okay, now a restructuring is a program that is planned and controlled by the management and has material effect on the scope of a business, okay, and the manner in which a business is being undertaken. Okay, but IS37 gave us examples of restructuring. As you can see here, sale or termination of line of business, fundamental reorganization, changes in management structure, closure of a business. Okay, so because of COVID-19, as I said earlier on, a lot of company has, restructured. They have, eliminated some layers of management, lines of business, so that to remain in business. Okay, now some people have also probably downsize. So the question is, can I make provision? Yes, you can make provision when an entity has created or what's it called, a constructive obligation. Now listen to me, you have to be with me here. So when you see a scenario-based question on restructuring, you have to check very well whether you can make provision. A board resolution or decision, do not create a constructive obligation. So what it means is, if the board of directors of your company just they did a meeting to say, out of 3 lines of business that we have, we are eliminating 1 line. Okay, that means all staff that are working under that line of business, they are gone. They are goners. Okay, so that means they'll be sacked. That's the meaning. Okay, now, so doing a board meeting and resolving that you are going to eliminate line of business as not constitute or created a constructive obligation. Okay, so before you can make provision, 2 conditions must be met. Number 1, there is a detailed plan for restructuring that identifies the business, the locations, and the employee affected, and an estimate of the cost and the timing involved. Okay, let me say that again. Before a restructuring provisions can be recognized, a detailed plan, there must be a detailed plan for that restructuring that identify the business to be discontinued, the location of the business, and the employee affected, and even the estimate, of the cost and the timing involved. Number 2, the employee affected have a valid expectation that the restructuring will be carried out. Why? It's either they have been informed or the restructuring has started. That's it. If those 2 conditions are not met, I cannot recognize provision. So if you see in a scenario-based question that the examiner just saying the board has met to discontinue a particular operations and they decide to create provision, that's wrong. Okay, you have to check again that is there a detailed plan for the restructuring that identifies the business, the location, and the employee affected, including the timing and the estimate of the cost that may involve. And the employee must also have a valid expectation that the restructuring will be carried out by either they have been informed or the plan has started. That's it. So that's the way the examiner can try to, take you around here. So how do you now measure restructuring provision? Okay, the standard actually, said those money you expend, they have to be actual. It's actually looking at actual sometimes, but sometimes it could be an estimate. Okay, but if the actual figures are available, that's fantastic. But it said they have to be necessarily entailed, in the restructuring and not associated with the ongoing activity of the entity. So that mentioned that training and relocation of staff, it should not be part of restructuring. Marketing activities, investment in future operating losses, obviously, they should not form part of restructuring provisions. Okay, so let's look at this question. Let's see whether we can see this question. It's very simple. Can you see it on your own? Okay, let me try and see. Okay, let's see. Said on 15th January 20X5, the board of directors of Shane voted to proceed on 2 reorganization schemes. Can you see involving closure of 2 factories? So the examiner can coin it by saying on that particular day, the board of directors voted to proceed on 2 reorganizational schemes because of the effect of COVID-19 pandemic. involving two closures of two factories or closure of two factories. Share reporting date is 31st March, and financial statements are authorized for issue on 30th June. Okay, so that sounds familiar, right? Okay, under S10. Now, scheme 1, what is it saying? It said the closure cost will amount to 125. Factory is rented on a short-term lease, and there will be no gains or loss arising from the property. The closure will be announced in June and will commence in August. Okay, that's fantastic. Now, the cost will amount to 45,000 after crediting 105,000 profit on disposal of certain machines. The closure will take place in July, but redundancy negotiation began with the staff in mind. For each of the schemes, discuss whether a provision should be recognized. If so, at what amount? Okay, so it's clear, it's provision here. Okay, now, so it's not telling me to say, okay, so I needed something here. I needed an information here. Okay, it said the year ended was what? 31st March. So that's very key. Okay, and the financial statement will be authorized for issue. Abby, is that 3 months after or 2 months? Okay, so 30th June. That's fantastic. Okay, now in the first scheme, it said the closure cost is 125. That's fantastic. So they are actually estimated it. Okay, now said the factory is on a rent and there is no gain and loss. Okay, so now said the closure will be announced in June. Okay, it will be announced in June and will commence in August. Okay, then I ask myself, before I can make provisions for restructuring, we said 2 conditions must be met. There must be a detailed plan for the restructuring that identifies the business, the location, and the employee affected. Can you remember? And even the timing and the estimate cost. I think they must have done that here. Then number 2, okay? Number 2, the employee has a valid expectation that the restructuring will be carried out, either because they have been informed or the redundancy has started. So if my accounting year end is 31 March, okay, and they said it's going to be announced in June. Can you see? It will be announced in June and it will commence in August. So when I'm preparing my accounts as at March 31, can I make provision? No, okay, because there was no obligation at the end of the reporting period. Can you see now? So that's the way you interpret question. There's no obligation, okay, because this is in June, okay. The closure will be announced in June, okay. It will be announced in June, okay. Now, but when I come to scheme 2, they said the cost is 45,000 after crediting 105 on profit of sales. So I need to add this 105,000 back to 45,000 to have 150,000 for the restructuring provision. So the question now is this: should I go ahead and recognize it? Let's find out. It said the closure will take place in July after the reporting period, but redundancy negotiation will start began in March. That is before the end of the reporting period. So for scheme 2, I can decide to create provision because redundancy, the 2 conditions are met actually, and the second condition that says the employee must have a valid expectation that the restructuring will be carried out, either because they have been informed or redundancy has started, okay, or restructuring has started. Can you see now? He said, but redundancy negotiation began with staff in March, okay? So the second scheme, they can go ahead and recognize provision. That's the end of the question, okay? That's the end of the question. So you can look at that other one. You have the solutions there, okay? And that is the end of provision. So you can see the sum here is very straightforward. I think I also, okay, you have some practice questions, okay? So there's an answer to that. So go through them. If you're having issues, let me know, okay? It's very, very straightforward. Okay, yeah, this is what I was saying. I think I also demonstrated it in a diagrammatic way. Okay, so you can go through that, okay? So you have some review questions as well. So make sure you go through them. If you're having difficulties, let me know. So let's quickly look at S20. Let's quickly look at S20, accounting for government grants and disclosure of government assistance. It's very straightforward. We should be able to do this in the next 15 minutes. Then we look at the last standard for the webinar and we say thank you for your time. Okay, accounting for government grants and disclosure of government assistance. So I'm also expecting the examiner, and even in practice, I think government grant is also coming to the spotlight because of the COVID-19 pandemic. There were a lot of relief, that were being given or granted by the government. Okay, normally or naturally, government will not give you anything for free. Okay, they will not give anything for free. There's always a condition attached to the government grant. And if you look at it very well, most of the grants or the bailout fund that government is granting or is giving some companies, okay, is just for the fact that you don't want them to probably sack their staff so that they can retain their staff. That's the whole idea. For example, recently they gave some grant to, I think they started from the pharmaceutical companies, and I think CBN, there's also CBN relief fund for is this small and medium enterprises, okay, and and they're also planning for the airlines, okay. So when you have this money, how do you go about it? So you need to apply IS 20. That's how to account for government grants and disclosure of government assistance. So what do we do around here? So in case you don't have a policy on how to treat government grants in your accounting, in your what's it called, accounting policy. So after learning this evening, you need to go and review your accounting policy in case you also benefit from government grant. Okay, so what do you do around here? So government grants are assistance by the government in form of transfer of resources, okay, in form of transfer of resources in response to compliance to past or future conditions, that relate to the operating activity of an entity. So like I said earlier on, they will not give you anything for free. So because of COVID-19, actually, you might decide to also get some government grant. You're going to pay back this money. It's not for free. Okay, it's not for free. You pay it back. So the only thing is, at best, they can say is without interest. Okay, they can say it's without interest. Okay, I think recently my company they also give us some money, even though we are not really badly affected by COVID-19. They gave us 2.5 billion naira. Okay, so that's government grant. We're going to pay it back over, was it 5 or 10 years without interest? Okay, so those are the COVID relief that they are giving. Okay, so how do we do that in the accounting system? So if you're a very good accountant and you have IS 20 at your fingertips, you don't need to run away. So when I see those accounts as a risk manager and I check my company's account, I know I have an added advantage. I'm a risk manager, okay, so I see no accounting standards, so I can easily query my CFO by saying, how did you treat these things? Okay, so that's it. So what do we do here? From the definition I just said, there are two things. We have what we call transfer of resources. Okay, I'm trying to write it down in my jotter here. Transfer of resources. Okay, transfer of resources. Okay, that's when government is giving you money, it goes in form of transfer of resources. So the government can decide to give you money. Okay, the government can decide to give you money. That's what is common now because of COVID-19. Okay, they decide to give you money. And when they give you money, we call it grant related to income. Okay, grants related to income. Everything is in your notes. Actually, everything is there. But like my own system, I don't like looking at the notes. So let me just flow the way I'm talking. Okay, just listen and understand. Okay, so at your leisure, you can go through those notes. Okay, so when the government gives you money directly, cash, we call it grant related to income. Okay, when they give you assets, okay, when they give you assets, then you call it grant related to asset. Okay, you call it grant related to asset. Okay, so when they give you money, okay, the examiner can take you on again. Another name for grant related to income is what we call revenue grant. Okay, revenue grant. Revenue grant. Okay, so I did revenue grant. Okay, so that's what we call grant related to income. Why am I laughing? Okay, I'm just trying to produce everything from my memory. I think it's been a while. I take lecture on IS 20, so but everything is there, it's upstairs. Okay, so I can easily reproduce them. Now for grant related to asset, it is called capital grant. Okay, it is called capital grant. So why am I doing this? I'm not taking you the practical aspect alone at work. Okay, I'm also taking you the way the examiner can also paint it in the exams. Okay, so the examiner says explain the term revenue grant, then you know that it's grant related to income, money. Okay, and if they say capital grant, that is grant related to asset. Okay, so that is transfer of resources. You know, I told you that they will not give you anything for free. Okay, so that's a condition that is attached to it. For example, they can say because of COVID-19, I'm giving you this money so that you can keep your staff. Okay, so that should not be what's it called? You should not sack your staff. I think FRS also gives some relief. You remember they said companies that did not sack any of their staff because of COVID-19, they will get back 50% of payee by the end of December 2020. I think you should be aware of that. Okay, that's part of the COVID relief that government is trying to give. Okay, just retain your staff, continue to pay them salary, continue to pay payee. Okay, by December 2020, we're going to give you 50% back. Okay, so that's kind of packages they are giving. Okay, so when they say keep your staff, you can also say set up your operation in a rural area. Okay, so that is the condition attached to it. So government will never give you anything for free, but in case you have some donation that we're giving for free, there's nothing free in accounting. Okay, there's nothing free in accounting. So if somebody should give your company money, okay, and it's not from the government, so you have to determine how do you treat it. You take it straight away to other income. That's it. You just credit your other income and debit your cash. It's as simple as that. Okay, but once it's government and the money is coming from the government and there's always a condition attached to it, then you need to consider IAS 20. So what is my recognition criteria? Let's quickly look at that. Recognition criteria under IAS 20. There are two recognition criteria before I can recognize money coming from the government. There are two conditions that need to be met. Number one, there must be reasonable assurance. There must be reasonable assurance that the grant will be received. Okay, there must be reasonable assurance that the grant will be received. And number two, there must be reasonable assurance that the entity will comply with the conditions attached to the grant. There must be reasonable assurance that the entity will comply to the conditions attached to the grant. Okay, once those two conditions are met, I can decide, I can go ahead to recognize government grant. Okay, so that's recognition criteria. Let me say that again. Number one, there must be reasonable assurance that the grant will be received. And number two, there must be reasonable assurance that the entity will comply to the condition or the conditions attached to the grant. Okay, so once those two conditions are met, I'm good to go. How do I now recognize them? Measurement now. Okay, measurement. Okay, so how do I measure? Measurement criteria. That's what I want to explain now, and that's where the calculation falls into. I've told you, always bother by recognition criteria and measurement criteria. So I'll take it one by one. The first one that we have is grant related to income. Okay, grant related to income. So the government is giving me money. Okay, and how do I account for it? So you have to be with me here. IAS 20 allows two choice of accounting. Okay, so that's what we are going to call method one. We are going to call method one and method two. Okay, we are going to call it method one and method two. It allows two choice of accounting. You can either use method one or method two, depending on the choice of accounting policy that you are choosing in your company. But it's very good for you to understand the two methods, because every questions I've seen, the examiner will always ask you to calculate method one and method two. Okay, but for income, it's very straightforward. It's only assets that is always giving some, some little itches, but we are very simple. I'm going to break it down for you. Okay, now, so let's find out under method one. So let me quickly say this. When income is coming on, okay, government has given you money, okay, you can treat it as part of other income, okay, treat it as part of other income. So in my other income, I'll just say government grant. I'll take the whole money there. That's it. I'll take the whole money there, okay? I'll take the whole money there because it's money. I'll just take it there. So I'll treat it as part of other income. Okay, now in my method two, okay, you remember, I think you know what other income is. Remember those days accounting that we used to do, the T format account. If you remember, on the left hand side, that's the debit side. You say opening stock, hard purchases, less closing stock. Can you remember? On the right side, it says sales, less returning what. If you net it together, you have your gross profit. Okay, you say gross profit carry down to the right hand side. That's the other income. And under the debit side, you now begin to list your expenses, tea allowance, photocopy, fuel, electricity, and everything. Okay. On the right hand side, you have gross profit. So this count received will be part of them. So that's what we mean by other income. So before you net it off to get your net profit. Okay. So, but in the normal, in the what's it called? New modern day accounting, you don't do T format again. You just start with the revenue, cost of sales, you get your gross profit, selling and distribution, blah blah blah. You get your operating profit, you have your tax, then you now say other comprehensive income. So within your other comprehensive income, you take the government grant there. So that's what they mean by treat as part of other income. Okay. Now for method 2, what do you do? Now be with me here. Where in method 1, when the grant is coming, I allowed it in my financial statement by treating it as part of other income. But under method 2, what do? I will deduct the grant from the related expense. Okay, I will deduct the grant. Okay, I will deduct the grant from the related expense. I told you that the government will not give you anything for free. So, for example, the government has said recruit fresh graduates because of COVID-19, okay? Because people are losing jobs, okay? But I want you to help me to recruit fresh graduates. So if you recruit fresh graduates, out of the money you are supposed to pay as their salary, I'm going to give you some relief, okay? I'm going to give you some money. So if let's say for example, the salary of the fresh graduate is going to be 1 million per annum. I'm just giving an example, okay? Let's say it's 1 million naira per annum. That is the cost, okay? Or the related expense to maintain those fresh graduates. And the government is now saying if you recruit fresh graduates, out of this 1 million naira, I'm going to give you let's say 600,000. Okay, 600,000. Okay, so when I'm using method 2, what is that supposed to mean? I will deduct the grant from the related expense and I will recognize the net amount. That's the meaning. So I'll simply say, how much is the grant? 600,000. How much is the related expense? Okay, that's 1 million. So I have 400,000 left. I'll just take the 400,000 into my books. That's what they mean by deduct the grant from the cost of the related expense and recognize the balance in the income statement. That's it. That's when it involves money. So if you like, you can use method 1. That means you take the whole 1 million into your account and you treat it as part of other income. And if you like, you can deduct it from the related expense and debit the net amount in the income statement. So IS 20 allows those choice of accounting. But if you look at it very well, the examiner can take you on if you are taking corporate reporting. For financial reporting people, the examiner may not bother you. Sometimes I just have to take you to another level, especially when I'm facing professional class, okay? Because that's what your own, you're not a professional. In the skills level, that's how they call it, skills level, application level. They are still learning the basics, okay? So here, the examiner can tell you between the method 1 and method 2, which one do you think is appropriate? Even though IS 20 allows the 2 methods to be used, okay? You can only use 1 method, you can't use 2, you can't be changing anyhow, but you can actually change. When we come to accounting policy, very shortly, I'm going to show you when you need to change your accounting policy, okay? Now, so in case the examiner should bring you on and ask you, which do you think, which of the method do you think is most appropriate? If you look at method 1 is consistent with the conceptual framework that prohibits offsetting. There's something we call offsetting. For example, you are owing me 100,000. In another transaction, I'm owing you 80,000. So instead of you to pay me my 100,000 and I pay you your 80,000, we can just offset, okay, to say just give me the balance of 20,000. That's the meaning of offsetting. But the conceptual framework prohibits offsetting. That is why when you are preparing your account, you recognize revenue, you recognize expenses, you recognize income, you recognize liability, you recognize assets. You have to show everything, okay? You have to show everything because you cannot aggregate. You can only aggregate immaterial item, okay? So that means the method 1 is consistent with the conceptual framework. But the problem around method 1 is this. Some school of thought believe that government grant is not something that will continue into perpetuity. It's just something that comes once in a while. So why do you need to recognize it in the financial statement? Since it will not form part of future cash flows, okay? That's some school of thought, okay? Now, in my method 2, you know, I would have deducted from the source. I just debit the net amount in my income statement. So some critics or some school of thought also criticize that because they said, why will you have to deduct? That means you are not showing the true what's it called, the source of that event or the source of that money. That means you are not showing it in the financial. So you should have, you know, tell us where the money is coming from before you debit the net amount. Okay, so that's it. Can you see now? So that's the way you explain to the examiner. However, IS20 allows either of the two methods to be used. That's it. So that's grants related to income. So let me now take you on grants related to assets. That this is where we'll be doing so many calculations, okay? Because that is most likely where the examiner will bring you on, because grant related to income is pretty straightforward, okay? So let's look at grant related to assets, method 1, okay? Method 1. Anytime I'm taking a strength, I like to write it. That's why I'm just writing my notes here. Okay. Now, method 1. Method 1. Now you have to be with me here. Method 1. So I would still use the same example. Okay. You know, this is an asset. If the government is giving you an asset and you don't know the value, you have to use fair value, okay, to determine the value, okay. Or they can also give you money to buy an asset. So in this case, it's not related to income, because related to income simply means it's an expense, okay? It's an expense. Now, when they give you money to buy an asset, so it's grant related to assets. So in my method 1, what do I do? So be with me here. So let's assume that the cost of the asset is 1 million. Let me use the same example, okay? And the grant I'm being given is 600,000, okay? Now, and it is related to assets. Grant related to assets. Another name is a capital grant, okay? In my method 1, I will set up a deferred income, okay? Set up a deferred income and spread over the useful life of the assets. Set up a deferred income and spread over the useful life of the assets. Let me demonstrate that to you. Let's say the cost of the asset is 1 million, okay, and the grant is 600,000, and it will take 5 years. You know, I will depreciate the asset for 5 years, okay. So normally, if I want to depreciate the asset for 5 years, I will say 1 million divided by 5, okay. I will have 200,000, okay. Now for the what's it called, the grant that is coming, I will also divide it by that 5. You know, that's why they say set up a deferred income and spread over the useful life of the asset. So when I do that, I will have 120,000. So what it means is this: now the cost of the asset is 1 million, and I will depreciate every year. I will depreciate by how much? 200,000, okay. But the grant was coming as well to cushion the effect of that 1 million. So that grant that is coming, I'll have 600,000. Okay. Now, this is the idea. The idea is that if I'm buying an asset that will use 5 years, okay, and government is giving me a grant for that asset, it doesn't make economic sense to consume the whole 600,000. I have to consume it in relation to the cost of the asset, or in relation to the useful life of the asset. That's what we call matching concept principle. That's it. It's consistent with the conceptual framework. So what it's saying is set up a deferred income and spread over the useful life of the asset. So what do I do? 1 million divided by 5 is going to give me 200,000. So as I'm releasing depreciation of 200,000 every year, I'll also be releasing 120,000 as income every year. I will now call it government grant. I will simply say 600,000 divided by 5. It should give me 120, right? So it should be 120,000. So as I'm releasing depreciation, okay, you know, I'm releasing depreciation of 200,000, I'm releasing 120,000 income. So the net amount, you know, the net impact is 80,000 in my account. That's it. It's as simple as that. That's why I said set up a deferred income and spread over the useful life. That's method 1. Or then under my method 2, what do I do? It's so similar to method 2 of, you know, grant related to the income. So what do? I will deduct the grant from the cost of the related asset and spread over the useful life. That's it. So when the grant is coming, Okay, I will say, Grant, how much is it? He said 600,000. How much is the cost of the asset? He said 1 million. I will deduct it immediately. So when I deduct, what's it called? When I deduct 600,000 from 1 million, what do I have? I have 400,000. I will now divide 400,000 by 5. So when I divide 400,000 by 5, what do I have? I have 80,000. Can you see? It's still the same. You know the other one to had impact of 80,000 as the net amount. So when I divide by the 400,000 by 5, I have 80,000. So I'll just be recognizing depreciation of 80,000 in my account every year. That's it. That's it. So the first one is showing the source, both the income and the what's it called, and the grant, both the cost, depreciation, and the grant. Okay. The second one is just showing the net amount. That's it, and that is the end of IAS 20. The other part is disclosure of government assistance. Disclosure of government assistance. So what is that supposed to mean? Disclosure of government assistance, the government assistance are those assistance that we cannot reasonably place value on them. Okay, we can't place value on them. For example, the Federal Safety Commission, they came to your office and they give your driver, training services for free. Okay, you can't really place value on them. Okay, so or they gave you some technical research, okay, support for research. You can't really place value on them. That's what we call government assistance. Okay, IAS 20 requires that you can only make a disclosure when it comes to government assistance. Don't really need to calculate anything around that because you can't really place value on them. And that is the end of IAS 20. It's very simple, right? Okay, so it's very simple. Okay, so let's look at some questions. Then we say bye-bye to IAS 20. So let's look at this question too. Let me use this question to first, build your understanding. Then we look at the one bigger question and we are done. Okay, so a company is giving 300,000 on 1st January 2021 to keep staff employed within a deprived area. Can you see? The company must not make redundancy within the next 3 years. By December 2001, no redundancy have taken place and none are planned. The grant will now be released over 3 years. Okay, you can't consume it in one accounting year. That means you divide this grant by 3 years. Okay, so in year 1 you release 100,000. Okay, and in year 2 100,000 like that. Okay, so that is very simple. So that means in my at the end of year 1, I would have released 100,000. Now, be with me here. Let me explain this. At the end of year 1, I would have released 100,000 as income in my income statement, right? Or government grant. Okay. So, how much liability do I have? I have 200,000 left. How much will be due in the next 1 year? 100,000 will be due. How much will be due in the next 3 years or 2 years that is remaining? Another 100,000. So that means 100,000 will become current liability because it will be due in the next 1 year, and the last 100,000 will be due after 1 year. That's the non-current liability. Okay, so that's what that is explaining. I'm going to show you more what I just said now. Okay, so let's look at this question to demonstrate what I just said now properly again. Okay, here it said an entity opens a new factory and receive a government grant of 15,000 in respect of capital equipment costing 100,000. It depreciates all plants using 20% per annum. Show in the statement of profit or loss the extract in respect of the grant in the first year under both methods. Can you see? Under both methods. Okay, so the examiner wants me to use both method 1 and method 2. Okay, so in my method 1, I remember treat as part of other income. I'm talking about asset now. Okay, because I need to find out. Let me find out. He said he gave me a government grant of 15 for a capital equipment. Can you see? He gave me money to buy capital equipment. So it's a grant related to asset. Okay, so I remember my method 1. He said my method 1 says set up a deferred income and spread over the useful life of the asset. So how do I do that? In my income statement, I will simply ask, how much is the cost of the asset? He said it's 100,000. How much do you want me to depreciate? He said 20%. So if I can calculate 20% of 100,000, it's going to mean 20,000, right? I will take 20,000 as depreciation into my income statement. Then in the same income statement, I will also release this grant, Abi. So when I say 20% of 15,000, how much would that give me? To give me 3,000, Abi. Okay. So I will also release 3,000 for for the first year, okay? Now, each year, I'll be releasing 20,000 depreciation and I'll be releasing 3,000 depreciation, okay? So, what do we now mean by deferred income? So in my balance sheet, I will show the kind amount of this the asset, within my non-current asset, which is the 20,000. How much is that? 100,000 minus the depreciation of 20,000, so to give me 80,000. So within my what's it called? Current liability. That's my equity now. I will have to recognize that's what they call deferred income. Okay, I'm defining that in money. Okay, but I will recognize it within my liability. That's where you just have to place it, even though it's not really consistent with the conceptual framework. Okay, I've told you earlier when I was explaining. Okay, now, so what do I do here? Now, be with me here. I out of the 15,000, okay, I have released 3,000. Okay, I have 12,000 left. So out of the 12,000 that is left, how much will be due next year? Hello, my people. Are you sleeping already? Don't sleep. So you have to listen to me here. This is the what's it called? The most technical area around that is strength, but for me it's quite straightforward. Okay, now I have 15,000 as government grant. Okay, I've already released 3,000 into my income statement. How much is left? 12,000 is left. Out of the 12,000, how much will I release next year? I will release another 3,000. Okay, how much is left? 9,000. The 9,000 will become my non-current liability. So that means 3,000 will become current liability and 9,000 will become non-current liability. It's very simple. Okay, let me show you that. I think I have it somewhere here. Let's see. Okay, can you see now? Can you see current liabilities? Sorry, non-current liability will be 9,000. Can you see government grants? And current liability will be 3,000. It's very simple because it's 15,000. 3,000 is already gone into income statement for the year. So 3,000 will be due next year, and the balance of 9,000. That's what you have here. It's very simple. Okay. So, and for the second method, you deduct the grant, from the cost of the asset. So how much is the grant? How much is it? Was it 15,000? Okay. And how much is the cost of the asset? How much? Let me try and press the calculator. The cost of the asset is 100,000, right? Okay. So when I deduct 15,000 from 100,000, I have what's it called? 85,000. Then I calculate depreciation on that 85,000. That is 17,000. That's how you got that 17,000 there. Okay, and you recognize the asset. So here you don't do in the statement of financial position, you don't do deferred income here because you have already deducted it from the source. Okay, so that's it, and that's the end of that question. So let me now take you on a bigger question. You can solve that question one on your own. It's very simple. Even the solution is there. So let me look at this question two, so that we can demonstrate our understanding. And we say bye-bye to IAS, what's it called, 20. Okay, so in many countries of the world, the government provides financial assistance to industry in form of a grant. In accordance with IAS 20, accounting for government grants, it said explain grants related to assets and grants related to income. So everybody can do that one. It's very simple. Can you see? It's very simple. So I can't imagine the examiner is testing IAS 20 and you cannot handle the question. No, it's not possible. It's very simple. So let's look at this big part of the question. It said, Prospect Nigeria PLC obtained a grant of 100 million from the federal government for an investment project to construct a plant costing 880 million. So it said to construct a plant. So obviously, this is grant related to asset. Okay. Now, the principal term of the grant as follows: grant payment will be made, subject to attaining a minimum level of plant expenditure. The secondary intention was to safeguard 500 jobs, and the grant will have to be repaid on pro rata if there is underspending on the capital. 20% of the grant will have to be repaid if the jobs are not safeguarded until 18th month after the date of the cost of capital expenditure. Prospect Nigeria PLC completed the construction plant on 1st January 2021 at the cost of 900 million. Okay, 900 million. The plant has an expected life of 20 years. Okay, and it's depreciated on a straight line basis. Required: state the type of grant that Prospect Nigeria has obtained, giving reasons for your answer. Is grant related to asset? Why? Because it involves involvement of constructing a capital item. That's it. It's very simple. You now said in requirement 2, show how the assets and the grant will be reflected in the statement of financial position as at year ended 31 December 2013, 14, 15 under both methods of accounting for government. Can you see? So you have to learn the two. Okay. So that's what the examiner is asking me. So when I see this kind of question, what do I ask myself? He said I should use method 1 and method 2. And I remember that under my method 1, I will set up a deferred income and spread over the useful life of the asset. Okay, so that's what I will do. Okay, so what do I do here? I will ask the question, where is my grant? Or let me start from, where is the what's it called, cost of the asset? Okay, it said, you know, here they said the plant costing 800 million. That was an estimate at the beginning of the contract, but at the end we spent 900 million. So don't be confused here. So the cost is 900 million. So I will use the completed cost, the cost of completion. Okay, so it's 900 million. That's my cost. Then I ask the question again, where is my grant? It's going to tell me. He said government granted us 100 million. Can you see? It's going to tell me. Then I ask again, how do you want me to depreciate? He said 20 years. That's the information I needed. It's as simple as that. And he wants me to calculate for 3 years. So I simply write, let me check those years. It said 2013, 14, 15. So I simply write it out. Method 1, treat as a deferred income, or set up a deferred income and spread over the useful life. So what do I do? Okay, so in my income statement, I will recognize depreciation for the 3 years. So how do I know my depreciation? It's simply 900,000 divided by 20 years. That's it. I know my depreciation in both in year 1, year 2, and year 3. Okay, then I look at the grant again. It said it's 100,000 divided by 20. So when I divide 100,000 divided by 20, what do I have? Okay, so that will be my grant for each of those years. And I go to my balance sheet, I recognize the asset, and I set up deferred income. I recognize current liability and non-current liability. That is the end of the question. It's so straightforward. It's so simple. So you can't see this kind of question and you are struggling. So let me show you. Can you see? This is method 1. Okay. So you have 900,000 because that was the cost. So since I maintain 900,000, so that means I will do accumulated depreciation. In year 1, it's going to be 45,000. In year 2, it's going to be 90. That's 45 plus 45. It gives me 90. And 45 times 3 years, it gives me 125. But if you like, when you do year 1 and you have 885 here, you can decide to bring the 885 here. It will be the new balance in 2014, and for here it will be 45. Okay, so once you have 810 here, you can decide to bring the 810 here, and you do 45 here, you still have the same figure. Okay, so in my current liabilities, okay, you know, when I divide 100,000 by what's it called, by 20 years, okay, to give me 5,000. Okay, so that won't be constant. So in year 1 I have 5,000, in year 2 I have 5,000, in year 3 I have 5,000. Okay, so in my year 1 in 2013, you know, I've already released 5,000 into the income statement. Abi, can you remember? And 5,000 will be due in the next 1 year. So out of 100,000, what do I have left? I have 90,000 left. That's why you have 90,000 here. 5,000 has gone into my income statement. 5,000 will be released next year, and I have 90,000 here out of 100,000. So every year I'm releasing 5,000. That's why you see this figure there. Okay, so that's it. Then you go to your income statement. You simply recognize your depreciation and your income. Can you see my depreciation for each year will be 45,000? Can you see 45,000, 45,000? And my income for each year will be 5,000. I'm done with my method 1, and that's the most difficult word that I think is difficult, but for what you can see is not really difficult. Then you go to method 2. Here you deduct the grant from the cost of the asset, which is 100 minus the 900. You have 800. Can you see? And the 800 that you have left, you divide by 20 to get your depreciation, which is 40,000 each year. Okay, but because you are maintaining a constant cost, so you have to accumulate the depreciation here. Okay, and your income statement, you simply recognize only the depreciation of 40,000. Okay, so that's what you have here, and that's the end of my strengthening. It's very simple. It's very simple. Okay, so if you have one question there for your what's it called, for your practice. Okay, so let's go to the last standard for the night. We really appreciate your patience to stay with us. Okay, so but these are very important standards that we need to look into. So I can take you IS 8 before 11 p.m. we are going to be through. Okay, so let me just teach you the basic principle, then I explain some questions, then we are off. Okay, let's look at accounting policies, changes in accounting estimates, and errors. So there are three things. So the first thing is accounting policy. Okay, now every company has a policy. Like I mentioned earlier, there's something we call accounting policy. So accounting policy are the principles, the practices, the conventions, the practices that an entity applies in preparing and presenting financial statements. Okay, so all the principles, all the conventions, all the bases and practices that you apply in preparing and presenting financial statements is what we call accounting policy. So if you are taking financial reporting, you might try to consider what is accounting policy, because the examiner can take you on that. But if you are taking corporate reporting, don't even bother. So I don't expect the examiner to start asking you what's an accounting policy. Okay, so that is the meaning of accounting policy. So you need to understand that. So an example of accounting policy is depreciate all non-current assets. Okay, depreciate all non-current assets. That is a classical example of an accounting policy. Okay, depreciate all non-current assets. Okay, now so we have known what is accounting policy. Okay, so that's the first thing we need to know, meaning of accounting policy. So the second thing we need to know is this, selection of accounting policy. So you need to be with me here. This is an highly examinable area. Okay, this is an highly examinable area. I have told you the meaning of accounting policy. We have to look at the selection of accounting policy. Okay, and I will also take you on circumstances in which an entity can change their accounting policy. We're going to find out then how do you account for a change in accounting policy. That's all. Okay, so we are going to basically look at 5 things under here, then we move on. Okay, now you have to be with me here. Okay, I have given you an examples of accounting policy, Abi. Now, so let's look at selection of accounting policy. So be with me here. The examiner can decide to call selection of accounting policy as basis of accounting policy. I think it was tested in financial reporting in May 2016. If I remember, they call it basis of accounting policy. That means what are the factors or what are the bases that an entity will consider in selecting the accounting policy. So in case you have that scenario in the question, or in case you are faced with this in a in a life case scenario, okay, at work. So what do? Number one, you have to check whether that area is covered by an IFRS. So it's possible that there is an event that occur. For example, COVID-19, it's not leading to certain events and transactions to occur. Then you're asking, you want to now formulate an accounting policy. That's what they mean by selection of accounting policy or basis of accounting policy. Then find out whether that area is already covered by an IFRS. So if the area is covered by an IFRS, it's very simple. That means just apply that particular IFRS to that event or transaction. That's it. Okay. If an IFRS applies to an item in the financial statement, the accounting policy or policy to apply to that item must be determined by applying the standard. Okay. So if there's an existing IFRS that applies to that particular policy or to that particular event or transaction, so what do? Apply that particular IFRS. That's it. That's what you tell the examiner. Okay. Now, on the other hand, if the area is not covered by an IFRS, so what do when selecting accounting policy? According to IS 8, if there is no rule in IFRS that specifically apply to an event or transactions, it therefore means management must use its own judgment in developing an accounting policy. Okay, that's it. That's what you tell the examiner. Management must use its own judgment in developing an accounting policy. And once they do that, those policies must be relevant to decision making. They must be reliable. They must represent faithfully result and the financial position of the entity. They must reflect the economic substance of transactions and other events. They must be neutral, they must be prudent, and they must be complete in all material respects. So you don't need to bother yourself too much. Just understand that we have 4 hours here. That's the way you can learn it. We have 4 hours here, and you have a prudent, a neutral, and a complete. That's it. That's the way you learn it. Okay. They must be relevant. They must be reliable. Represent faithfully. Reflect the economic substance of transactions, and they are neutral, prudent, and complete in all material respect. Okay. So that's what we tell the examiner. And the ISA now went further to say, in making those judgments, management can consider the following factors or sources in descending order. That's a requirement or guidance of IFRS that deals with a similar standard or similar issue. Okay, then the definition, recognition, and measurement criteria as contained in the framework. Okay, so that's it. That's what you need to know. So in case the examiner is bringing home, okay, I think in November 2019 again, they bring it on again in financial reporting. It was brought on again in financial reporting, but this time around, okay, the examiner did not ask directly what are the selection or the basis of selecting an accounting policy. Do you know what the examiner says? The examiner said, if I can remember very well, said, if an entity is trying to develop an accounting policy in the area of depreciation and inventory, what are the things they need to consider? Okay, that's exactly what the examiner is asking. And in case you see that question, this is exactly what you tell the examiner. You just tell the examiner that if it is an area covered by an IFRS, okay, they should apply that particular IFRS. If it's not covered by IFRS, they should use the what's it called, a judgment in developing an accounting policy. Okay, I'm pretty sure most students cannot handle that question. And it's very straightforward. Okay, he just said in the area of depreciation and inventory. Okay, what basis of accounting policy can an entity use? So this is what you're telling the examiner. Once you're able to tell your examiner like that, then you have your maximum mark. It's very simple. Okay, it's very simple. Now, be with me here. Now, an entity don't just change their accounting policies. Okay, so that means you can't wake up one day. Okay, you cannot wake up one day and say you want to change your accounting policy. It's never possible. Okay, there are 3 things that may happen for you to change your accounting policy. Okay, for example, if you are using cost model, you cannot just wake up and say you want to start using revaluation model. Okay, you can only do that if any of these 3 conditions has occurred. Number 1, it is required by a statute. For example, CAMA. Okay, you know, there is a new this thing that was just signed, CAMA, a new law that was just signed into law. That was a revised amendment to CAMA, August 7, just on Friday. It was just newly signed. So if CAMA, that's a statute, right, requires that your policies should change, then you can do that. Those are the circumstances in which you can change your policy. Number 2, if it's required by an IFRS, okay? If it is required by an IFRS, maybe a new standard was just issued that will require you to change your policy. For example, the IFRS system we just mentioned earlier on, it was never treated as an on-balance sheet financing. It's normally treated as off-balance sheet, okay? All of a sudden, IFRS is taking on board to say you have to change that policy. So you don't have a choice. You have to follow the provisions of IFRS, of the new IFRS. Another example, or another classical example, is IAS 23, borrowing cost. Before now, if you go to the bank to borrow money, the interest elements on that borrowing are usually expensed. IAS 23 now came on board. It now says part of the borrowing, part of the finance cost can be capitalized as part of the cost of the asset. Okay, so that's a classical example of a requirement of an IFRS. Okay, so when it's required by an IFRS, then you can go ahead and change your accounting policy. You have to be consistent with the IFRS. And number 3, which I normally have issues with, okay, anytime I lecture IAS 8, I said, for me, in the whole curriculum of ICANN, IAS 8 is the most difficult standard for me personally. Is the most difficult standard. That's why most lecturers, they don't even want to take it. Okay, but there's a way I can, break it down for you guys. Okay, and you understand. That's what I'm trying to do. Now, that is the reason why I have issues with number 3. So let me mention number 3 to you. Number 3 is, you can also change your accounting policy if it will make your financial statement to be more relevant and reliable. So you can go ahead and change your accounting policy. So that means that the third condition has given companies the leverage to change their policy. That's the meaning. It has given them leverage. I could have preferred that the IASB will stop at number 2. If it's required by a statute like CAMA in Nigeria, or it's required by an IFRS. So it will box most companies, in changing their accounting policy. But then number 3 has said, if you think it will make your financial statement to be more reliable and relevant, oh, that's a problem. So I can wake up one day and say, oh, I no longer want to use cost model. I want to start using valuation model, and I change my policy. Why? Because when you start using cost model, what happens? Evaluation model, what happens? Even though my depreciation will go up, but my gearing will come down because of the revaluation surplus I would have recognized over there. Okay, there are usually implications of changing accounting policy. Okay, so and when you're also doing your ratio analysis and all of that, changes in accounting policy is also a major limiting factor. That's why comparability is also always a problem. Okay, so that's it. So those are the 3 things that you need to learn in case the examiner is asking you what are the circumstances in which or what a company can change the accounting policy. You simply tell the examiner if it's required by a statute such as CAMA in Nigeria, or if it's required by an IFRS or interpretation, or if it will make the financial statement to be more relevant and reliable. But I needed to explain further because my people that are taking corporate reporting, okay, in case the examiner is asking you. Even in practice, that's what you consider. Then how will I know that there is a change in accounting policy? So you have to be with me here because change in accounting policy is not the same thing as change in accounting estimates, okay? So how will I know that there is a change in accounting policy? So those are the 4 things. We have looked at the definition, we have looked at selection of accounting policy, we also look at the circumstances in which I can change my accounting policy. The 4th one is how will I know that there's a change in accounting policy, and the last one is accounting for a change in accounting policy. And we say bye-bye to that part. Then I quickly look at estimates and error, and that's the end. Then we can go and sleep, okay? So we should be able to do that in the next 30 minutes, okay? So, sorry. Now, how will I know that there's a change in accounting policy? Anytime you see a scenario-based question, or the examiner is trying to ask you whether it's a change in accounting policy or not, or somebody calls you just because you are not a chartered accountant, that to tell you whether it's a change in accounting policy, ask yourself 3 questions. Number 1, is it affecting my recognition basis? Okay, is it affecting my recognition basis? So what do you mean by recognition criteria? I've told you earlier, if you remember, that anytime you look at standard, think of the technical definition, recognition, measurement, and disclosure requirements. So when I look at, when I want to determine whether there is a change in accounting policy, I look at recognition basis. Is my recognition basis changing? Okay, is my recognition basis changing? So let me give you a very classical example. I used to expense my what's it called, finance course. Can you remember? Before IAS 23, okay? IAS 23 now come on board. I normally expense it. When I expense, I take it to my profit or loss account. So because of IAS 23 now, it now say I can capitalize. So that means I'm removing it from my income statement and I'm taking it to my balance sheet. Recognition is changing, okay? My recognition criteria is changing. So it is a change in accounting policy. Then number 2, I ask myself, is my measurement criteria changing? Okay, is my measurement criteria changing? For example, when I want to value my inventory, I normally use LIFO. What is LIFO? Last in, first out. All of a sudden, IFRS 2 prohibited LIFO from being used to value inventory. It now said I can either use FIFO method, that's first in, first out, or I use the average method. Okay. So that means my measurement basis is changing. Okay, my measurement basis is changing. So it is a change in accounting policy. So if I'm using LIFO before and I need to use FIFO now, it has changed. Or I'm using cost model before to value my assets, but now I'm changing to revaluation model or fair value model. Okay, so my measurement criteria has changed. It's a change in accounting policy. And the 3rd one, for me to know whether there is a change in accounting policy, is a presentation basis. Okay, how do I present my figures in the financial statement or some items in the financial statement? For example, depreciation. I used to recognize depreciation within cost of sales. Okay, that's my policy, that all depreciation are charged to cost of sales. All of a sudden, I decide to change it, and I take depreciation charges out of cost of sales, and I'll take it to, let's say, or what's it called, admin expenses. Okay, so it's changing from admin expense from cost of sales to admin expenses. So it's also a classical example of a change in accounting policy. So whenever you have a scenario-based question, or even in practice, you want to determine whether it's a change in accounting policy or not, then you ask yourself these three questions. Is my recognition criteria changing? If the answer is yes, it's a change in accounting policy. Is my measurement criteria changing? If the answer is yes, then it's a change in accounting policy. Is my presentation basis changing? If the answer is yes, it's also a change in accounting policy. No, naturally, all these three cannot happen at a time, okay? It is one of them. So once one of them is changing, it's a change in accounting policy. So let me now take you on how to account for a change in accounting policy. How do you account for a change in the accounting policy? And that's the end of accounting policy, okay? I'm trying to explain everything in the note. Okay, so you have to be with me here. Accounting for a change in accounting policy. I wish I can stand up, to do some demonstration around here, but I can't. Okay, so let me just try now. So let me start. Okay, so what happened is this: there's a change in accounting policy in 2019. Okay, so when I'm preparing my account in we're in 2020, right? Okay, let me use 2020. So when we were preparing my account in December 2020, there was a change in accounting policy. How do I know that was a change? For example, I used to recognize interest expense in the profit or loss account, but now I'm changing that policy because it's required by S23 that I can recognize it in my in my balance sheet. You can actually do that if it relates to a qualifying asset, but because we're not doing S23, so don't let me bother you on that. Okay, so if it relates to a qualifying asset, so what's a qualifying asset? The qualifying asset are those assets that take substantial amount of time to get ready for intended use or sale. For example, construction of Third Mainland Bridge, it takes a lot of time. Okay, so that's just by the way. Now, in 2020, I changed the policy because I'm changing my policy in 2020 because it's either my recognition business is changing, or presentation is changing, or measurement criteria is changing. So I changed my policy. Okay, I will now go back to last year. I will restate that. The account of 2019 is gone already. Okay, I've already done it. My expenses, my interest expense are recognized in the income statement, okay, or in the profit or loss in 2019. But I says go back to last year and restate. Why am I doing that? For comparability, so that I can compare those two accounts. If you notice, in most financials analysis, you have to have minimum of two accounts for you to compare together, so that you can analyze the performance of the companies properly. Okay, so I go to last year's account and I will restate. That means I will also go and capitalize those expenses by taking them out of the income statement and capitalizing them as part of the cost of the asset. Why am I doing that? For comparability. That is what we call retrospective adjustment. Okay, I go to last year and restate. That's what we call retrospective adjustment. So when you're accounting for a change in accounting policy, it is accounted for retrospectively. That's it. So in case the examiner should ask you, for the financial reporting student, what is the meaning of retrospective adjustment? It simply means you go to the last year's account and you change the figure, okay, for comparability purposes. That's it. And that's the end of what's it called? Accounting for a change in accounting policy. So it simply means this year, change the policy. Then go back to last year's account and restate. Why am I restating? For comparability. Okay, that's it. Then we now move to what's it called? Accounting estimate. Okay, accounting estimate is okay. There's something they call impracticability. Let me quickly say that impracticability. Okay, let me get to errors. I'm going to explain that. I won't forget, don't worry. I won't forget. Let me get to errors. Okay, so let's go to accounting, what's it called? Changes in accounting estimate. Is an adjustment in the carrying amount of an asset, or what's it called? Or liability, okay? Or related expense. It's an adjustment in the carrying amount of an asset or liability or related expense resulting from reassessing the expected future benefit of or an obligation associated with that asset or liability. So when there's an adjustment in the kind amount of an asset or liability or related expense, that's a change in accounting estimate. Okay, I'm sure you are familiar with estimate. Okay, when you are doing provisions the other time. Okay, so estimate can be as a result of bad debt. You need to make some estimate. Maybe warranty provisions, you need to make estimate. You also make estimate around the useful life of an asset. Even when you are determining the fair value of an asset, you also make a lot of estimate. Okay, so that's an example. It's very simple. So all you need to know is what is the change in accounting estimate. You need to know that. Number two, examples of change in accounting estimate. I've just told you. And number three, how do you account for a change in accounting estimate? So be with me here. A change in accounting estimate is accounted for prospectively. A change in accounting policy is accounted for retrospectively. However, a change in accounting estimate is accounted for prospectively. Okay, that means you change the estimate now, the accounting estimate now, and you continue like that, just like depreciation. What's it called? The method of depreciation. Now, be with me here. If you notice, when I define accounting policy for you earlier, I said, for example, depreciate all non-current assets. I did that on purpose so that you don't mix it up. When you say depreciate all current assets, it is a policy. Then the method of depreciation to use, whether to use straight line method or reducing balance method, is an accounting estimate. Okay, is an example of accounting estimate. So when my depreciation method is changing, it is not a change in accounting policy. Okay, because it doesn't affect my recognition, it doesn't affect my measurement, it doesn't affect my presentation. It's just a pattern. It's just the pattern that I want to use to depreciate those assets. Okay, so it's never a change in policy. It's a change in accounting estimate. So how do I do that? I account for it prospectively. That's it. So let's now go to the last one, which is prior period error. So what is that supposed to mean? I'm preparing my account this year, and I realized that there was an error that was made in 2019's account. You know, when error was made in 2019's account, what happens to the opening balance, or let's say closing balance for 2019? You know, the closing balance in 2019 is automatically the opening balance for the current year. That means it's affected already. I will go back to that last year and adjust. Okay, that means the change in error is accounted for prospectively, naturally. Okay, so what is a change? What is a prior period error? Okay, they are omissions and misstatement in the entity's financial statement for one or more period arising from failure to use or misuse of reliable information. Can you see? You failed to use those information, or you misuse the information that was available when the financial statement were authorized for issue and could reasonably be expected to have been obtained and taken into account, okay, in preparing those financial statements. So you need to know some examples of error. Okay, some examples of error. So you might need to, have some example. For example, could be effect of mathematical mistakes, oversight, fraud, that you did not discover at that time. So those are omissions in the financial statement. Okay, misuse of accounting policy can also be an example. Instead of you to, for example, IS2 has placed a ban on LIFO, you still continue to use the LIFO, and you say that, oh, it's an error. You need to go back and use the appropriate accounting policy. It's not a change. Okay, so that since you made an error, you misuse the accounting policy, then you go back and change it. Okay, and that's the end of IS8. Okay, I've explained everything. Now I remember, so I said I want to explain impracticability. We said error will occur in one or more prior period. Okay, so it's possible that when I'm preparing my 2020 account and I realized that there was an error that occurred in let's say 2017 that we did not see. We now saw it in 2020. So what it means is I need to go back to 2017 and change the error. Okay, so that it will affect 2018's account, 2019's account, and 2020's account. So impracticability means if you cannot go back to that 2019, then go to the extent of the year that you can go to. Okay, so if I cannot go back to 2017, for example, because maybe I was using Tally accounting software there, so in 2018 or 2019, I changed to Sage. So most of those information in 2017, I may not even have them again, okay? So I can start from 2019 or 2018. That's what I mean by impracticability. So if it's impracticable for you to go up to 2017, just go to where it is practicable. That is practicability, and change the error automatically. It will affect other figures, okay? So that's what it means. So you see all of them, when you are reading them, it will make a lot of sense to you, okay? When you are reading them, it will make a lot of sense to you, okay? So I've broken them down. So let's just look at questions and we'll say bye-bye. Thank you for signing on the webinar, okay? So let's look at this question to demonstrate our understanding. Let me read the requirement first so that I'll just be answering it when I'm reading, okay? So don't waste time on that. It said, identify whether the following constitutes a change, that should be above, okay? A change in accounting policy or a revision accounting estimate or correction of error. Okay, fine. Okay, so the examiner wanted us to find out whether it's a change in accounting policy. So as I'm reading, be answering it in your mind, okay? You don't need to type it, just answer it in your mind. But I will tell you the answer. The answer to this is not here, so you might need to write it down somewhere, okay? Or you may not even write it down since you understand, so you can always answer it at any time. It said, you are a senior accountant at First Choice Academy Limited. While proofreading the financial statement for the year ended 30th June 2018, Lisa, a trainee accountant, has identified certain changes in the last year's financial statement, but she's unsure whether they represent a change in accounting policy, a change in accounting estimate, or correction of prior period error. So one of them, the first one is previously, FCA Limited accounted for its non-current asset using historic cost basis. In the current period, however, FCA has adopted revaluation model under IAS 16 to account for its non-current assets. So when I see this question, I ask myself, is it a change in accounting policy and a change in accounting estimate on error? He said, I used to use cost model, now I'm using revaluation model. Then I'm asking myself, does that affect my recognition basis? No, it does not affect my recognition basis. Does it affect my presentation? No, it does not. Does it affect my what's it called? Does it affect my measurement basis? Yes, it affected my measurement basis because I'm changing from cost model to revaluation model. So that is a change in accounting policy. That's how to deal with the questions, okay? So let's look at the B part of the question. It said, FCA Limited had a policy of calculating depreciation on equipment using straight line at 10%. However, in the light of significant losses recognized on recent disposals, okay, management has decided to depreciate equipment using the reducing balance method at 20%, which is more accurately reflect the wear and tear of the equipment. So is this a change in accounting policy or is it an error? Obviously, it's not an error. So it lies between change in accounting policy and estimate. Okay, so I ask, does it affect my recognition? No. Does it affect my measurement? No. Does it affect my presentation? No. Obviously, it's a change in accounting estimate because I used to use straight line method. Now I want to start using the evaluation method, okay? So it only reflects the pattern of estimate, okay? That's it. Now, the C part of the question. It said, FCA Limited has a policy of valuing inventory brought forward to the current period, that is, last year closing period balance, has been changed because it had erroneously valued using LIFO. Erroneously, even from the word error. So it's an error. It's a prior period error. Even, so that's it. It's a prior period error. So it has already even told me, said erroneously. So I have to go and correct that error, okay? Now, let's look at the D part of the question. It said, SCA has a past practice of recognizing sales revenue at the time of dispatch of goods to the retailers. Okay, so when I dispatch, I recognize revenue. In the current period, however, sales has not been recognized by SCA Limited until goods sold to retailers have been resold to the end customers. Management believes the new recognition rule is more accurate. Rule more accurately reflect the economic substance of the sales and returns arrangement to retailers. So this one is looking like they used to use IFRS 18 revenue, but now IFRS 15 revenue. Okay, so this is a change in accounting policy. Now from this one, it said the new recognition. Can you see new recognition? It's even giving me a clue. Okay, so previously I will recognize at the time of dispatch. Once I take it out of my warehouse, I recognize. But no, I'm not saying, because I now realize that some of them, they even take it back. Okay, and I say once it is sold to customer, so I'm changing my policy. So my system of recognition is changing. Okay, so that is it. Then in estimating the employee benefit obligation of FCA Limited at the previous year, the actuary failed to take into account FCA Limited plan to discontinue operation in one of its geographical segments. Management has announced plan 3 years ago. Recently, the actuary furnished the revised estimate of the FCA Limited's liability with respect to employee benefits in the current period. Okay, and the financial statement of this year has been adjusted now. So is it a change in accounting policy? Obviously no. Is there an estimate? Now be with me here. So the fact that they mentioned recently they actually furnished a revised estimate does not automatically mean there is a change in accounting estimate. So you have to look at it very well. He said in estimating employee benefit obligation, FCA Limited has previously at the previous year end, the actuary failed to take into account. That means he made an error. Okay, if you look at the definition of prior period, it said they are omission. Okay, he omitted or misstatement in the entity's financial statement for more than one prior period error. Okay, so those information that we're supposed to take into account, either you did not take them into account or you omitted them. Okay, that in those period. Okay, so this is a type of error. So he made those error. Okay, so that's it. So let's now look at question 2 very quickly. Question 2 very quickly. Let's look at question 2. It said, Allen Construction incurs significant finance costs in its financing for construction of supermarket. The choosing accounting policy date has been to expense finance cost as incurred. Can you say it will expense it as incurred? So this is the final account. Now said the directors of Allen Construction has now decided to change the policy in 2013 to capitalize finance costs. Can you see? So I don't need the soothsayer to tell me that the policy is a change in accounting policy. So we used to expense. Now in 2013 we have changed. Okay. So then now say required, show how the change in policy be reflected in the income statement and the changes in equity. That's fine. So, and I remember, how do I account for my change in accounting policy? This year, I will change and I will go back to last year and restate. Okay. So this year, my policy is changing. Okay. In 2013, can you see? So I'll just say profit before interest and tax. I'll write 8,007. Finance cost. Instead of me to recognize it, this will be 0. I'll take it off. That means I'll take it into my balance sheet. They didn't give me information on balance sheet here, so I don't bother. They are more interested in the income statement. So I take it to 0, okay? The same thing last year. I'll go back to last year and restate, which is 2012. Here, I will also remove it, okay, to be 0. So that means my profit before tax will remain 8,700 million, okay, or 700,000. So I have my income tax expense. They didn't tell me whether this is affected, so I leave it like that. Okay, so the same thing here. That's it. It's as simple as that. So let me show you what was done there. Can you see? Can you see now? So that's what you have here. So you have 6 hits here and you have 4 hits here. Now, if I did not go back to 2012, okay, the profit for the year would have stood at 3,050. Can you see? But because I've gone back, it stood at 4,800. That's the essence of comparability. Can you see? Comparability, you can easily compare 6.8 to 4.8. That's reasonable. Unlike if you have 3.50 there, okay? So that is, in fact, like more than double in the second year. So that's why for comparability, you have to go back to last year. So the examiner now said I should also calculate changes in equity, okay? For everyone here, let me revise this to you. So what constitutes my equity? If you are doing your group accounting, you have something we call net asset acquired. Net asset is different from equity. So let me quickly clear that, okay? Equity constitutes your share capital, which is also known as equity, okay? Share premium, okay? So when you have share premium, share capital, it forms part of your equity. Then you have, what's it called? You have retained earnings, okay? Share capital, share premium, and retained earnings. okay? And sometimes in corporate reporting, they can also call some things other components of equity. So those are what forms your equity. So, but for my net asset acquire, everything I just mentioned also forms part of net asset acquire. But one thing that is also common there is the fair value adjustment, okay? So that's why net asset is different from equity, okay? I think I was lecturing one day in a class and somebody just asked me that question. I just said, oh, what a fantastic question. So I just went to the board and I analyzed it. It's as simple as that. So I needed to quickly tell you that. So when the examiner now says, calculate changes in equity, so out of those equity I just mentioned, then you ask the one that needed to change here. That's it. Do I have share capital here? No, I don't. Do I have share premium here? I don't. Did they give me other components of equity? They did not. Did they give me retained earnings? Okay. Then I ask, where's my retained earnings here? Okay. I think they gave us, right? Can you see? Retained earnings. So that's the change in equity this guy wants me to calculate because of the effect of finance cost that needed to be, that has changed. Okay. So I will now calculate my retained earnings. Can you see? So my retained earnings for the opening balance in 2012, which is 23,000. Let me show you that. Okay. Let me show you the question. This is it. This 23,000. So the balance I have here is the balance at the beginning of 2012. Okay. So it's the balance at the beginning of 2012. So obviously, if you had the profit for the year in 2012 to this 23,000, it's going to give me 050. That's it. Okay. It will now be the opening balance in 2013. That's why you say balance brought forward. Okay. So the balance at the beginning of 2012 is going to be 23,000. And I had a new profit for the year. Okay, the profit for the year, which is 48. Can you see? That's the, because of the effect, that's it. This is the 48 here. Can you see? We have removed the effect of the interest element. Okay, you had it. Okay, so you have a revised opening balance as at the beginning of 2013. Okay, so how much was my profit for the for 2013? That's the 68. Can you see it here? That's the 68. Okay, you had it there, and the examiner said, then you have asked, did they pay any dividend? Because dividend is paid out of profit. Abi? Okay, he said they pay dividend of 1 million. So I will remove it so that I can get the revised, what's it called? Revised closing balance. Can you see now? So I have a new closing balance to be 33,600. It's very simple. Very simple. Okay, we have 2 more questions to go. Okay, we have 2 more questions to go. We have 5 minutes left. So let's find out. Now it said Giant Limited has an asset which was purchased for 80,000 1st January 2015 with a useful life of 10 years and a residual value of 10,000. Okay, on 1st January, the directors reviewed the useful life. Can you see? They reviewed the useful life. So that's a change in accounting estimate and found that it now have 8 years. Okay, it has 8 years. So it's very simple. So what do I do here? I will ask, how much is my cost? It said it's 80,000. So how do I calculate my depreciation? I'll simply say cost minus residual value over number of years. So 80,000 minus 10,000 divided by 10 years. Can you see that? So when I calculate that, I have my depreciable amount. Okay. So when I have that depreciable amount, so what do I do again? I will now calculate the accumulated depreciation up to the date the useful life was revised. Okay. So I bought it 1st January 20x5. It means I will depreciate December 20x5, 20x6, 20x7, 20x8, 20x9, 2010. That's it. I'll depreciate for 6 years because they revised it on the 1st January 2011. So I'll simply say the figure I got for my depreciation multiplied by 6, okay? So to give me this 42, that's how you have this 42 there. So I'll have a new carrying amount of 38,000. So they now say when they revise the useful life, it is now 8 years. And we said whenever there's a change in accounting estimate, you treat it prospectively. Okay, so I will now have to recalculate the depreciable amount by looking at the current carrying amount and the residual value, because they didn't tell us whether the residual value has changed. It still remains at 10,000. So I'll now say 38,000 minus 10,000 divided by the 8 multiplied by 1, because he said I should calculate up to December 2011. Okay, so to give me 35. So that's what you have there. It's very simple. Very simple. Okay, very simple. So let's look at the last question and we'll call it a day. It said during 20x7, FCA Limited discovered that certain items of certain items had been included in inventory as of December 31, 2026, valued at 4.2, which had in fact been sold before the year end. We have sold this inventory, but we are still carrying it in our books. So that is an error, okay? So they gave us the income statement, okay? Now said, retained earnings as at 1st January were 13 million, and cost of goods sold include the 4.2 million error in the opening inventory. The income tax rate was 30%, no dividend was paid. Required, show how the income statement for 20 Excel with 20x's comparative advantage and retain earnings. Okay, so what do I do here? So I'll simply come back here and write this statement out. So I'll say sales, I'll say 47,400, what's it called, 67,200. Okay, so it was, so you can change it. They wrote 20x's first and 2017, so you can change it. So just take 2017 first, because normally current year should be the first. Okay, so they made the error in 20x's, so that means I'll go to 20x's and remove the 4.2 million? Was it 4.2? Let me find out. Yes. Okay, so it's 4.2. So I need to go back to last year and adjust, because we have sold it, but we are still carrying it. So how do I do that? You now do what's it called? You now do workings. So you now say cost of goods sold. So the way it is as per the question, you're going to list it out. Okay. So you now go back to 20x6. You now bring on the 4.2. Normally, when you are deducting a negative figure from a negative figure, you add back. Okay, if you understand your mathematics, especially if you go to private school. in primary school, we went to public school. But we still understand, really. Sorry. Okay, so you add back. Okay, so you add back. So that's what you have here. Normally you are reducing it, so that means my gross profit should come down. Okay, so in the current year, you will now remove. Okay, adding back means you're actually removing, okay, because it's a negative figure. So if you come here, can you see? So you now bring the figure here. So my profit before tax has reduced by, can you see, to 8,630. If you are getting a figure, can you see, more than 11,400, that means you are wrong. That's the meaning. So you have to remove it because that's been sold. Can you see now? So that's how you know that, Abi, sorry. What am I doing here? That's 12,830. But here in 20x's, you have 8,630 because of the effect. Okay, so that's what you do to the second year too. Okay, you remove. Okay, now for the tax effect, they give us 30% effect. Okay, so you also do the same thing. So you just do the opposite of what you did over there. So on the tax effect, you calculate 30% of 4.2 million. So you have 1.26 and the 30% of 4.2 million in the current year. Okay, so you now bring those figures here. Okay, so that's what you have here. Don't worry, just take your time to go through it. I know we are very tired now, so I'm just trying to explain, but if you don't see, understand, we are together. Okay, so we are together. So in my retained earnings, what will I now do? So what is my opening retained earnings? So let me go to the main question. Okay, they said on 1st January, can you see my retained earnings was 13 million? Okay, my retained earnings was 13 million. So normally that's 1st January 20x6. So if you had the profit for the year, this profit has the error. But if you had it to hit, it should give me that 8,950 plus 13,000 should give me 21,950. Okay, so that's why you have this 13,000 here for last year. That's the retained earnings. Okay, and the profit for that 2016, if you add it up to give me the opening balance in 2017, you now adjust for the error. So the error was 4.2 million minus the tax effect. Okay, I'm adjusting everything in the current year. So I have this figure as restated, this figure will still remain. So what was the profit for the year? So the figure I got here, which is 10.9, that's what we have here. And this figure I got here, which is 6, that's what we have here. And this is the balancing figure. That's it. And that is the end of IAS 8. That's the end of IAS 8. So for people in corporate reporting, you have some questions here. Go over them when you have your time. But for people in corporate reporting, especially, this is for you, okay? everything I've explained is here. Okay, everything as explained, the impact of changes in accounting standards and policy. If you are doing what's it called, financial reporting, you may not bother yourself, but if you want to broaden your understanding, you can also go through this. Okay, so I've explained in fact, right from yesterday, I've been talking about this because IS 8, in football, you have a midfielder like JJ Okocha when he was playing, like Zinedine Zidane, they are number 10. So that's the way IS 8 is. IS 8 is at the midfield, okay? It's supplying IFRS 5, all those other standards. It's at the center. So there's no way you talk about that standard without having impact on IS 8, okay? So that's why I said it's the most difficult standard, because it has link with, even when you're doing ratio analysis, okay? It has link with them. So that's why I have to put this there for you so that you can read. So in case the examiner should ask you some scenario-based questions, so based on what I've read here, it's going to help you. So thank you for your time. We had about 1 hour extra in addition to the specified time, but I didn't really want to rush you so that you take some value out of the webinar. So we so much appreciate you for signing on to the webinar, that took us to just spotlight some key accounting standards when it comes to COVID-19 pandemic. So we appreciate your patience, but like how we say, we are still together, okay? We are together, and if you have questions for people that just sign on to add some additional knowledge, that's fantastic. And some people that are also preparing for ICANN exams and ACCA, I wish you the very best. Once they announce the date, we'll still have some rush hour program that we can quickly do to also, assist you in your exams. So thank you so much. I want to believe you enjoy yourself. Thank you for signing on. So let me hand over to my host to give us the what's it called? The rounding up message before we go finally. So my host, are you still there? Or is my host sleeping already?
Yes, I can hear you clearly.
All right, so let's see you on video. So you're welcome. So let's just give us some. Thank you.
Thank you very much, Mr. Yomi Ladokun. Thank you for a powerful total package on IFRS. Thank you for updating us on the new spotlighting major accounting standards. Really appreciate. And once again, to the participants, I want to say a very big thank you for joining us in our August 2020 webinar. Thank you for also being patient enough, especially having this additional that was not planned. I believe it's been a great session for you. So kindly be informed that the material has already been sent to the WhatsApp group, but you also have access to other details, probably the videos. The admin will communicate with you concerning that. So, and also we'll also send our social media pages so you can kindly follow us for future updates on other webinars for you to join us in. Thank you very much. We appreciate. Do have a lovely week. Bye for now.